By 0.5% versus the dollar. 210 seeing a vast amount of steepening. Yesterday, it was bear steepening as yields went above 4% across the curve. We saw the highest yield on the 30-year yield so far this year. Today, instead, it is bull steepening. But do you really want to ride that trade of buying treasuries in reaction to that Fitch news? It's what happened in 2011, but this time certainly is different. All right, let's take a look at futures as we're just seconds away from the open of these markets. It is a tough morning. DAX futures down more than 1%, nearly down 1 1/3%. CAC around, it is down squarely 1 1/3%. Again, the fear in this market is more technical in nature. Perhaps we were just over positioned and a lot of positions will get blown out if it starts to turn more ugly. All right, we're just having markets open at this moment. Here we are on the GMM. Let's track it as they open. First out of the gate, as it always is the FTSE 100. We're seeing that decline about 0.3%. It goes down further. The more stocks are opening, the worse it is getting. Spain's IBEX opens to the downside by about 1% and some change. Again, overall, it was an ugly handoff from Asia. The U.S. session really turned to yesterday. We are really positioned short vol, and short vol on the front end of the volatility curve. That is worrying because there are not a lot of hedges being taken right now. The long end, on the other hand, we're not really long there. Could you get another volatility spike should these markets really start to deteriorate? All right, France is open. That is down 1 1/3%. You can really see the move to havens if you look across the entirety of the board. Dollar at the top of the pile for the Forex column. We're moving into the dollar. We're also moving into the yen this morning too. And sovereign bonds, those yields are pushing lower. We're buying them for the most part. We've just had another market open. We've had Italy open up down 1%. So just to recap, nearly every single region we've seen open so far is down at least 1%. UK, FTSE 100 doing a little bit better. Perhaps some of the consumer goods are helping us out. Again, we spoke to Hugo Boss and Hallian in the last hour. The consumer is still strong, especially in the US. That's not helping us here. Every single sector is in the red so far this morning, except for energy, and this is barely up. 0.01% is where we fall on energy. So getting a bigger look here, what's really dragging us down seems to be banks, for example. That's down more than 1%. Consumer goods down 1 1/3%. Tech is down. Retail down more than 1%. Again, even though we've had some more consumer-facing good earnings today, that showed resilience. It doesn't matter today. We are in a kind of sell everything type mood again, which suggests perhaps it's not the individual stock stories driving everything. It's this overall bearish sentiment that seems to be seeping into the market after the 5th consecutive month, last month, of gains for U.S. equities. Are we finally going to see that reverse? Okay, there's a lot driving this market. Let's try to get through as much of it as we can with Christine Aquino from our Markets Today blog. Christine, one thing that doesn't seem to be helping us, despite the fact we got news overnight, is China. We heard more pro-growth policies from the region. What are they saying?
Well, Danny, I think the latest that we've seen from China is the government encouraging local governments to do more in infrastructure spending to stimulate their domestic economies. But yeah, I mean, I think it really has been lackluster in terms of the reception to this policy. Again, investors still very much waiting for what we call the big bazooka of China stimulus, which I asked our China expert on the Markets Today blog, Sofia Horta y Costa, it really will boil down down to direct support for consumers, some version of the stimulus checks that we've seen in the U.S. perhaps, to really get investors convinced that China is on the up and up. Otherwise, I think that economic deterioration story very much still dominating for investors, and China really just has not paid off as the supposed positive growth story for 2023.
Look, one thing that might upend things even further, as if there isn't enough volatility today, we're on BOE watch. What are expectations at this moment? What could throw this market into another tizzy?
Well, Danny, as you know, of course, the base case is for a 25 basis point rate hike from the Bank of England, but there's still a lot of outlier views out there that they could go 50, right? And really, the way I see it is, it's kind of a damned if you do, damned if you don't situation for the Bank of England, and possibly for the pound as well, because the 25 basis point rate hike already very much baked in, and so for the pound, it's almost kind of, if the BOE does it as expected, then it's kind of a disappointing scenario for the pound, right? Because they didn't go more. But then, of course, if you do more for the Bank of England, that creates the risk of reviving all of these recession fears, which, of course, will be negative for the currency and just the general economic sentiment for the UK. So, tough place for the BOE.
Yeah, in the middle of this cost of living crisis, too, the big take today touches on that, but specifically when it comes to energy, it talks about one of the country's biggest energy producers, Drax. And it's at a time when consumers need energy relief. What is the loophole that has been exploited here that's, again, been another headache for the British consumer?
Well, Danny, it is essentially this tax loophole that they've been able to take advantage of without necessarily doing more to alleviate the pain of higher energy costs, right? And you can understand, on the one hand, of course, Drax as a company, it has shareholders, it has a responsibility to kind of generate those returns. You would expect that it would try and take advantage of everything they could to maximize profits. But I think where the anger is really coming from is the fact that they didn't really need to do all that much to get those profits, just because we saw those energy prices really soaring last year. I mean, we've seen that still lingering effect of higher energy prices in a lot of the energy company profits that we've seen even this earnings season, right? I mean, of course, they pulled back a little bit just because of that base effect, right. But still elevated profits for a lot of energy companies. And so at a time when they could have done more to help alleviate the cost of living crisis for UK consumers, they didn't. And that's really the issue.
Just quickly here, because we're running out a bit of time. Earnings season, you mentioned it with the energy companies. What's been your overall takeaway so far?
Well, Danny, the theme really is big buybacks, and we've seen it largely from big oil and big banks, and it makes a lot of sense. Banks really want to give those buybacks to investors before that benefit from higher net interest margins fades away. And then also for big oil, I mean, again, lower energy prices now, so we're not really seeing as much of a benefit there, but they still want to add that as a sweetener for investors.
Okay, Christine, thank you so much. That's Christine Aquino from our Markets Today blog, and you can get more from Christine and the team on the front page of the Bloomberg UK website or by typing TLiveGo on the terminal. Now, speaking of earnings, we're moving stocks, and let's get a check on some of those individual movers with Joe Easton. Joe, what you got for us?
So here's how the big stocks are opening up following earnings reports today. Danny, Helion, the unit of GSK that was spun off, that one opened pretty much unchanged, but now coming down a bit in the context of these broader market declines that we're seeing today. They have raised their guidance amid strength in some of those recession-proof products like paracetamol drugs and other consumer products as well. JDE Peet's, this is the big coffee maker, the maker of Kenko, another product that doesn't really decline with the economy, but that one dipping today. There's some concern around them closing some units over in Russia and the financial cost of exiting those. Hugo Boss, a little bit surprising, the second earnings upgrade for them in just 2 months, but it's only by a small amount, so perhaps the market wanted a bit more, and that one's down 4% in Germany. Also falling over in Germany is Healthineers. As we said in Stocks to Watch, analysts at Morgan Stanley calling for earnings downgrades after weakness in some of their MRI scanner businesses. So that one of the worst performers on the healthcare index today. Then we're going to flip over and look at some other UK ones, including Taylor Wimpey. That one is the best performing stock on the Stock 600 in early trading this morning, or it was when I was at my screen. They have reported a decline once again in some of their sales. but that already priced in, given a 40% slump in those home builder stocks last year. So investors buying into that one today. BAE Systems, the big defense firm, they've got some new contracts over in Saudi Arabia, which is helping to supplement their UK and US sales as well. Now, Hexagon over in Sweden, there's a short seller report out on this firm, but the company today is denying the accusations by that short seller, and the CEO buying some stock, putting some confidence into those shares over in Stockholm. Finally, on this board, Smurfit Kappa, don't underestimate the importance of cardboard boxes. All of the Amazon products that we buy sold by firms like Smurfit Kappa in terms of the packaging, but that one dropping today, that has had a good run recently following a boom in online trading, but that one has come down this morning over in Dublin, dropping about 4%. Going to finish off on a few other non-earnings related firms. So we got Nestle. They've been upgraded by HSBC following that strong report from them last week. Siltronic gets upgraded over at Exane, and Ferrari reporting earnings later today. Keep an eye on that one. The final one at the top, Klépierre, French real estate, had an earnings report out last night, and the market reacting positively to that one.
All right, Joe, thank you very much. A lot to sort through there. Joe Easton from our equities team. Coming up for the first time since early 2021, the Treasury will boost its so-called quarterly refunding of longer-term treasuries. We're going to discuss that and the impact on investors. Also amid a Fitch downgrade, what should you care about more? This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
I disagree with Secretary Treasury Yellen's notion that this was arbitrary.
Look, the Fitch rating downgrade came as a surprise.
It's a few things that do surprise us a little bit in terms of their estimates.
So there is a governance problem, and that is truly a problem that we'll face going forward.
This comes at an economically sensitive time, but I think it's the last thing that Yellen really needs. But from a market perspective,
If the U.S. economy continues to show resilience, I think markets will just rush off.
Some of the Bloomberg TV guests reacting to the U.S. downgrade by Fitch. I'd say some of the words from Larry Summers and L. Arian were a bit stronger than that. And look, treasuries fell yesterday across the curve. That news from Fitch did pare some of that loss. Even still, we saw the 30-year yield rise to the highest level since November. The really big driver of that does seem to be the U.S. Treasury Department preparing to ramp up issuance of longer-dated securities to fund a widening deficit, something they pinned at over $1 trillion. The Treasury also increased its net borrowing estimate. Again, that's the $1 trillion, and the time period for that is July to September. So how do you navigate all of this? Joining us now is Altaf Kassam, EMEA head of investment strategy and research at State Street Global Advisors. Altaf, great to have you in the studio this morning. It does feel like we're in those sort of edgy summer market period.
Right.
When you look at things like Treasury refunding and Fitch downgrade, how meaningful are they when you're making your investment decisions?
Yeah, I wouldn't quite call the Fitch downgrade a non-event, but, you know, we've known that Fitch have had the US on watch for a while, and they haven't really come up with any new information in their announcement. So for us, US Treasuries are such an important asset class that many investors are almost forced to hold, that we don't think it should trigger any new selling. Sentiment will definitely decline, and we've seen that on the open this morning. But for us, you know, it's something the market should probably get over in time.
In terms of the market declining this morning, I wonder what the potential here is for things to get much more ugly. You and I were talking about this in the commercial break, that the market is mostly short vol. You can see it in the VIX, take your pick, the normal VIX, the one-day VIX near a record low. Does that present an even more fragile market should a sell-off worsen?
Yeah, it does feel like the market has been kind of teetering on the edge of complacency, and that's always a dangerous time when news starts to come out like this downgrade. So it does feel like, and we've been telling clients to take advantage of this low volatility environment to put hedges on. We frankly haven't seen a lot of hedges being put on. So it does feel like this is a time where either people start shoring up their portfolios, but there is the risk that we see some sort of a cascade where this short vol becomes a bit of a spike in volatility.
What sort of environment requires that to happen? Is it just really steep loss in equities, 2%, more than that? Like, what is sort of the recipe that brings that about?
I think you need a steeper loss in equities. I don't think 2% is going to, given the gains we've seen so far, I don't think 2% is going to really trigger such a cascade. Another kind of bout of geopolitical risk, and again, that's always bubbling under the surface. It's barely gone away the whole of this year. And then I think if we do start to see people start rebalancing from equities into fixed income, which again, we haven't seen so far, but has been on the cards for several months, for example, defined benefit pension schemes, then we could start to see everything line up and a bit of a steeper fall in equities.
Could I make the argument, though, if we do see that, it'll be short-term, and the long-term trajectory is an American economy that's still okay, a Fed that hasn't broken anything yet. Maybe I don't need the hedges. Maybe I can wait it out.
Yeah, if you're a patient long-term investor, we do think that risk assets provide a good place to be, but a lot of people can't take that mark-to-market volatility. They have to talk to their stakeholders on a regular basis. And for them, we do think the idea of putting some protection in place right now, before volatility really starts to pick up, makes a lot of sense.
What about regional differences? In terms of sort of the U.S. versus Europe, which do you prefer at the moment? Because U.S., pricey, but Europe, eco-wise, dicey. That's my rhyme for the day.
That's a good rhyme. I mean, for us, we do still prefer Europe. It has kind of gone against us the whole of this year as the US has rallied very strongly, mostly led by consumer and technology stocks. But for us, we can't ignore that valuation component that you come up with. The US is really starting to look pricey. Unless you're a massive believer in the productivity gains coming from AI, for example, for us, the way that Europe is priced, the way that it's got its sector composition, And the fact that, it hasn't rallied as strongly as the US so far this year, for us makes a lot more sense to still maintain an overweight to European equities.
That sector composition, it's very value-oriented.
Yeah.
And that tends to outperform at the beginning of a cycle. So what does that tell you, or what is your assumption at where exactly we are in this cycle?
We still think real rates are going to keep rising. So even though we don't think the Fed should hike rates more, markets pricing it in, they probably could. We think inflation's going to keep falling. So for us, with real rates keeping going up, that's still positive for value, and that's positive for Europe.
Are real rates, are they going to go up enough to pop what Bank of America calls the baby bubble of AI?
We don't think that real rates are going to go up much more. It's kind of the dynamic is that we think rates are going to plateau, nominal rates are going to plateau, inflation is going to keep coming down. So for us, the bubble, if you call it a bubble of AI, is not going to be popped by real rates. I think it's going to be when, if consumers realize that these numbers are not justifying the rally that we've seen in AI stocks, but at the same time, we've been wrong before.
I gotta say, one of the things that was one of my assumptions heading into this earnings season, if we're admitting where we've been wrong, was the strength of the consumer, because we did see some patchiness from some of the luxury names, for example. But I spoke to Hugo Boss this morning, spoke to Haleon, we spoke to Diageo, we've spoken to a lot of consumer companies that have said, actually, the U.S. consumer is still buying. They're still purchasing things. They're still purchasing discretionary items, too. The U.S. consumer seems really strong. Do you expect to see cracks in that narrative?
Where we are starting to see cracks, and this is common across the globe, is that there's a big disparity between high-income and low-income consumers. High-income consumers, like you said, have still kept spending. They've still got cash that they hoarded during the pandemic. They've been spending on luxury goods. But if you look at the lower-income quartiles, and I guess this is across the board, they have started to show signs of stress. You can see that in credit card numbers, for example, and spending there has gone down. So the high earners have continued to keep spending. They still have that cash in reserve. The low earners have already spent a lot of that cash, and that's where we're starting to see the stress.
Yeah, and there was a recent UK survey that basically showed all the wage pickups, all the wage inflation is really confined to that upper quartile. So an excellent point, Altaf. Thank you so much for joining. Really appreciate your time. Altaf Kassam there, EMEA Head of Investment Strategy and Research at State Street Global Advisors. Now, another market-moving event ahead. It's the Bank of England's policy decision at midday UK time. The press conference will be about 30 minutes later. Don't miss that. First, though, coming up, the American Petroleum Institute says U.S. crude inventories decreased by 15.4 million barrels last week. Saudi also seeing their output drop further. We're going to discuss all of that next. This is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman sisters rather than Lehman Brothers, the world might well look a lot different today.
world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Market Today, 20 minutes into European trading session. A tough day, declines of more than 1% for the Europe Stock 600 and the DAX, a little bit better for the CAC 40 and FTSE 100 indices. You get the feeling that overall it is a nervous market. We're certainly on that edgy markets for the summertime with lighter volumes and news flow to digest. Now, one asset that has been doing well is oil. Last month, the best month since Jan 2022. It's resuming a rally this morning after an industry estimate pointed to a huge drawdown in U.S. inventories that added to signals that the market is tightening. Let's bring in Bloomberg's Paul Wallace on this. So, Paul, that rally over the past month, what was it down to, and what does that tell us about how much further it can go?
Hi, Danny. It has been quite something. I mean, we're almost in a bull market as far as oil is concerned. I mean, since late June, Brent is up just under 20%. I think the main thing that's driven that is the supply side of the market. That's something that oil bulls have been sort of flagging for a long time, but it's finally, let's say, swung in their favor. We've seen big OPEC plus cuts, chiefly from Saudi Arabia, and I think that's probably what the Saudis have done is probably the single biggest thing there. We've also seen some supply side concerns or disruptions from countries like Libya and Iraq to an extent, and also Nigeria, and that's what's driving it. We do have to also point out demand, and demand is probably, although it's very difficult to tell in real time, but demand is probably at an all-time record at the moment of about 102.5 million barrels a day. So those two combinations of things have really lifted prices.
How does OPEC Plus now respond to a price surge? We've seen their reaction to price losses. What happens this time?
Well, that is a big question for the oil market, and I think traders will be watching Saudi Arabia in particular very, very closely. So in the next week, maybe even in the next day or two, we should get an announcement from Saudi Arabia about what it's going to do for next month's production. So for this month, it's pumping it's meant to pump about 9 million barrels a day of crude, which is very low by the kingdom's standards. And it should say very soon what it's going to do for September. Most people think it will extend those cuts and keep pumping at 9 million barrels a day. There are some traders, though, that think it will look at the price rise and think that the best thing to balance the market is to reverse some of those cuts. So we'll be watching that.
Paul, thank you very much. That's Bloomberg's Paul Wallace. Oil at the moment up about 0.7% as the rest of risk assets tumble. Now coming up, trimmed. European stocks and U.S. futures fall. The U.S. is stripped of its top-tier sovereign credit rating by Fitch. We're going to discuss that next. This is Bloomberg.
not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg. This is Markets Today, 30 minutes into your European trading day, and here are your top stories. Fitch strips the U.S. of its AAA credit rating, citing ballooning deficits and an erosion of governance. Global equities sell off. The criticism arrives from that decision from leading economists like Larry Summers and Mohamed El-Erian. Treasury Secretary Janet Yellen calls it arbitrary and outdated. Plus, European earnings season continues. Hugo Boss and GSK's consumer spinoff Haleon both raised their guidance on strong sales as consumers continue to spend, but shares fall. All right, a quick look at your markets 30 minutes into your trading day. We're diving more than 1% for most of these indices. FTSE 100 a little bit of outperformance, but DAX, Europe Stock 60, those are falling by more than 1%. Let's take a look at which sectors are on the move this morning. It is all red. We don't see a single sector on the board there that has moved into the green. In terms of the worst performing, healthcare is at the bottom of the pile, basic resources, financial services, and retail. On the top end, it is energy. That's just down 0.2%. But overall, a tough day. So those are the sectors. Let's look at some of the individual stocks now and the ones that are on the move with Joe Easton. Joe, what you got?
So BAE Systems leading gains here at the moment in London and in Europe as well. The best performing stock on the Stock 600 this morning. This is as they report some strength from their contracts with Saudi Arabia and also general strength following those contracts won following the outbreak of war in Ukraine. Taylor Wimpey, meanwhile, the most surprising one for me, they have reported a decline in sales once again given the higher mortgage rates, but it is more resilient than some of the bears on the street had expected this morning. Meanwhile, Hexagon, this is a Swedish real estate technology company. A short seller report was out on this company, but they are denying the allegations made by Viceroy Research and the CEO buying stock, putting some confidence into that one in Stockholm. Finally, on the gainers, we've got Blanco Tech. This is a small cap UK cybersecurity company. It's got a takeover bid. They're based out in Essex and they are getting taken over at a premium. That one jumping on the AIM market today. In terms of the decliners, plenty to choose from. As the last screen you had up showed, Siemens Healthineers, the big decliner. They have some weakness in one of their cancer diagnostics business and also some general MRI concerns for the former Siemens AG unit. Hugo Boss upped its guidance for the second time in just 2 months, but it wasn't as big as some people had hoped for. They only increased it by a few percentage points. The biggest dropper in Europe today is a company called Revenio. This does eye care for hospitals. So it's eye products that sell directly to doctors. Now that is dropping 29% over in Helsinki after a profit warning, and that's been followed by a number of analysts cutting their ratings on the stock today. I've just brought up AMS, Osram. This is really representing the declines we're seeing in tech following the broader market's decline today. That one did have their own earnings, which were pretty weak. That was out last week, but all the tech stocks slumping with the broader markets, given the declines that you've highlighted this morning, Danny.
Joe, thank you very much for that roundup. Joe Easton from our equities team. Now, one of the things that seems to be causing some of the sour mood in markets was the news overnight, if you're here in Europe, that the U.S. has been stripped of its top-tier AAA sovereign credit rating by Fitch Ratings. The move echoes a change made back by the S&P in 2011, but U.S. Secretary of the Treasury Janet Yellen is not just taking it laying down. She said the decision was, quote, arbitrary and, quote, outdated. Joining us now is Ludovic Subron, Chief Economist at Allianz. Ludovic, thank you so much for joining this morning. Look, I'm sure you're waking up to a lot of this market trying to digest the news. What do you make of the reasons that Fitch laid out for the downgrade?
Well, I guess the fiscal metrics in the U.S. are not great, right? And so like a lot of countries, I think most of the recovery has been driven by very profligate expenditures, right? And so if you look at the unit of spending that it took to create a unit of GDP over the past couple of years, it's much more than it was in 2019. Actually, it's twice as more. So I think that's one. And then I think, there is something around the lack of a debt ceiling straitjacket. And the discussion last time about defaults, I think this created a bit of a knee-jerk reaction maybe among Fitch. And so the downgrade happened. It's a bit late to the game because the news seems to be good in the US when it comes to soft landing. But I think it's a reminder that there are still people, there are still super hawks out there that are watching and that are fiscally obsessed,
I was going to say, because we've gotten a lot of criticism off the back of it. We were just talking about Janet Yellen there in the introduction to you, Larry Summers, Mohamed El-Arian, plenty of people out there. And one of the consensus seems to be, Ludo, that this is a black mark, not on the United States, but on Fitch itself. What do you make of that reaction?
I find that fascinating as a European because, Americans flock together when there is a decision against them. So it's super bipartisan. The same people that have been calling the overheating of Bidenomics, or people that have been, quite respectful of some independence of some agencies are now saying, no, you guys are wrong. We're right. I think Europeans should learn a thing or two about this because, to be fair, when we have similar credit events, we tend to self-flagellate a lot more. So I think it's, from this side of the pond, it looks like, you guys are actually very united in this situation of, not great fiscal situation, but at least you're just telling Fitch that you don't care, which I think is quite amusing.
Americans not being humble, never, Ludo. I've never heard such a thing. But okay, so back to this idea of fiscal deterioration. How much worse has it gotten? Taking out Fitch's decision for just a second, over the past year, over the start of the year, has it gotten much worse for the U.S.?
Well, look, one thing is sure. I think inflation has been helping a little bit to deflate the debt to GDP ratios in the U.S. and GDP has been very strong. So that's good news because really we see the positive effect of the denominator, right, of the nominal GDP pushing a bit the ratios to a better direction. The problem is still that there is a lot of spending in the pipeline. There is still a lot of spending that has not been unwinded. And so the question that she's asking is the trajectory of fiscal. And I think it's a fair question to ask everywhere, because everywhere we have this discussion about, okay, how much of growth is led by fiscal? And there is, of course, a return of industrial policy. So a lot more interventionism in subsidies to companies. And of course, here I'm talking about the Inflation Reduction Act. And so I think there is a question that, there is no way debt or fiscal metrics are improving, at least in the coming months, apart from this inflationary effect on the debt level. And that's, I think, why Fitch is questioning. They need to have some form of direction that there is, a constrained spending in the US to make sure that it's a sounder spending environment.
But is there some degree which this is just too premature, Ludovic? This rating from Fitch, we're saying it's too late, but in some ways, is it too early? Because we are still seeing a very strong American economy. Yes, we are seeing more spending, but that has turned into a boom, for example, for manufacturing. We're seeing that sector recover. Is there some way which Fitch maybe should have just waited to see what that ballooning fiscal deficit would actually do to the American economy?
It's interesting because, you know, this is the same discussion you can have on markets, whether we are in an early cycle or late cycle phase. I think it's the same here. Do you think that it's an alarm bell, it's a canary in the coal mine, or do you think it's actually too late? I tend to think that the situation is not amazing. I tend to think that, you know, to be fair, if you take out, and we see that, for example, in Germany, where the moment that the government started to fiscally adjust, Germany plunged into recession. And I think we could ask the same question here, which is how much growth would you have in the US right now if there was not very strong fiscal stimulus into the economy? It's a wrong question to ask because somehow that's the role of fiscal stimulus, to make sure that you stay afloat. But there is still, in the current, you know, mix of growth and the contribution to GDP, there is still a very large role of public spending. And so that's one of the questions you could ask, which is this growth a trompe-l'oeil? Is this growth, you know, totally due to private sector spending and investment and exports? Not really. It's really still linked to a lot of subsidies into the economy. So that's a little bit the question you should ask, and whether there is a handing over of the baton to other growth drivers, which is happening in the US as we speak. So you see consumption still strong, but a bit losing momentum. You see investment strong. But the question is what happens in the second half of this year and the next year, especially because it's an election year. And we know it's going to look very much like 2016. Do you remember the Clinton-Trump, you know, riff-off? It was a very muddled through situation in the US, borderlining recession. And so I think that's a little bit what I'm fearing right now, is that it's not a pure recession, but it's a very muddled through situation all through 24. And so in that situation, fiscal metrics are going to deteriorate again. So that's something that maybe Fitch is, you know, warning the bells about. But yeah.
This idea of the fiscal support, can I apply that to the impact of monetary policy to Ludo? Is there some degree which what Jay Powell has tried to achieve, 500 basis points of increase, it's been hindered by spending brought on by, for example, the Inflation Reduction Act?
Completely. I think that's the situation we all have to acknowledge everywhere, that as monetary policy, you know, went back to its core, to its mandate by, you know, targeting price stability and therefore inflation, fiscal policy took over. And now the question is whether we can live in the near future with a toxic policy mix, with monetary policy being recessionary because rates are going to stay higher for longer, not at 5 or 5.25%, but maybe at 4 if there is a pivot in the second half of 2024. But then fiscal also needs to consolidate because the debt ceiling agreement is coming to an end within the next 18 months, right? So what happens when both fiscal and monetary stimulus are contributing negatively to growth is something that is not something you want to have just before election time, you know? And I think that's a little bit what the US should be prepared to manage, I would say, in the next 12 months.
Okay, Ludo, we really appreciate your time this morning, jumping on so quickly for us. That's Ludovic Chabran, Chief Economist at Allianz. Now, coming up, Italian luxury automaker Ferrari is set to report record sales volume later this morning. We're going to dig into the auto sector next. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Markets Today, 44 minutes into a European trading day. We're still moving lower, not as bad as it had been at the open, but still DAX underperforming. The higher beta sectors falling this morning. Most indices down about 1%. We've had a lot of automakers report earnings, and we're going to continue to get more today. Ferrari will be the next to report second quarter earnings results. Analysts say the sports car manufacturer could raise guidance driven by record sales volumes. Yesterday, rival Aston Martin announced that it had raised £216 million to pay back debt and fund its EV strategy. But the bad news came from BMW, which warned a smaller cash flow, free cash flow of about 6 billion euros. It had been 7 billion euros earlier. Joining us now is Daniel Ruska, a senior analyst at Bernstein. Daniel, thanks so much for joining the program today. Look, this BMW news basically saying that they're facing higher expenses for EV parts and it's a difficult supply chain. To what degree is this a BMW problem versus an auto industry problem?
Hey, good morning, Danny. I think it's a wider industry problem. I mean, what you're seeing is strong demands, still sticky inflationary costs for the second half, and troubles in downstream logistics. Now, for BMW specifically, they surprised people by raising their guidance on volume, so pretty strong in the second half. That, of course, needs working capital, but then also the working capital drag from logistics downstream issues likely led to the disappointment.
As that working capital drag plays out through the back half of the year, what does that look like, Daniel?
Well, you've got to assume that at some point we'll find enough trucks. And so for the broader sector, but also BMW specifically, we would expect the working capital to unwind again as we go into 2024. I don't think volume growth will be very high into 24. That gives you a little bit back. Then downstream issues clear up, and so the working capital drag should reverse for most automakers as we go into the next year.
What about the more premium part of the market? I mean, BMW does sit there to a large degree. We're going to get Ferrari, Aston Martin, some positive news there to help pay down their debt. Are we seeing a premiumization, as we are in many other industries in the auto market?
Well, what you're definitely seeing is that individual companies are trying to capitalize on that trend. Aston Martin is definitely moving upstream, right? Just a few years ago, their cars sold for 160,000. Now they're selling for 230,000 on average. You've got Mercedes with their economics of desire strategy moving up. But BMW's, while sitting at the premium market, is steadfast in maintaining a broader spectrum of products. And so you've got individual companies that are trying to move up, if you will. And some who say they're comfortable staying where they are. Overall, the premium market is growing slightly faster than the overall auto market if we take a longer-term view. So if you'd expect the auto market to grow at 2 to 4 percentage points, the premium market is probably growing around 6 to 8.
So concerns about the consumer, but still the upper side of things are still buying their Bentleys to drive around in. In terms of breaking it down by region, because there has been concern about the U.S. consumer, it's been kind of uneven in different earnings reports too from the car makers. Well, what's your overall read in the U.S. consumer as it pertains to their willingness to spend up to buy a car at this point?
The U.S. has been really surprising to everybody this year. What we've seen is that the absolute inventories that dropped to a record low during COVID, jacking up prices, the absolute inventory level has come up. We're about halfway, maybe 40% back to where we were pre-crisis, but the crucial measure of days of sales, so how much velocity is there in the sales, has actually come down, indicating that consumer demand right now for cars in the U.S. is rising faster than the inventory levels are rising. And that means discounts are still quite a few months away, or let's say significantly higher discounts in the U.S. are still a couple of months away, making the U.S. a very profitable market to be in at this point in time.
Interesting, and especially because a lot of the EV makers, this race to cut prices from Ford, from GM, from Tesla, from the Chinese automakers too, has that trend run its course yet? Or as you're saying, with overall some of the price discounts, is that still to come more viciously for EV for the rest of this year?
I think there are two levels to this, right? One is completing the regional picture, right? In Europe, we still have an order book on average between 6 and 8 months. That's shrinking faster for EVs, but it's still really good, right? Which means, you know, if you go and order a car today, for most models out there, you'll have to wait 4 to 6 months to actually get it. So no discounts in Europe on a broad scale anytime soon. And in China, the market already turned sour last year, right? The large volume growth happened last year, demand didn't pick up, discounts came up. We're right now at more than 20% discounts in the Chinese market across all ICE and EV cars, which is higher than it was pre-pandemic. And so you have this regional difference, US really good still, Europe getting slower but still okay, and China staying bad. The other dimension is to look at, as you said, the BEV sales, where kind of the strong push of China, BEV, and also Tesla has just created the supply surplus. And that's definitely weighing more heavily on BEV pricing than on the ICE side, the combustion engine side right now.
And in China, too, last month in June, rather, so 2 months ago, the Ministry of Commerce announced some measures to try to support consumers, to try to lift car purchases, a 6-month campaign and drive EV adoption in rural areas. Daniel, do you anticipate that helps the overall EV makers, or is this in some way targeted to China BEV makers?
I think this is more targeted to China BEV makers. Also, since you're not going into tier 1, tier 2 cities in China, the impact on the overall Chinese market will remain limited. So we don't really see a significant car stimulus at this point in time. We think China will first focus on its property market before it moves on later to its industrial sectors.
Daniel, really great to have you on the program this morning. Thanks so much. Enjoy the rest of your week. Daniel Ruska there, senior analyst at Bernstein. Now, tomorrow, Bloomberg will kickstart our coverage of the Aspen Economic Strategy Group. We're going to give you a whole lot of interviews with policymakers and executives weighing in on solutions to the biggest issues affecting commerce in the U.S. and throughout the world. Stay with us for that. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up? What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Markets Today, 53 minutes into European trading day. We're at the lows of this morning. Everything down by more than at least 1%. Some of the underperformers, some of those higher beta indexes, 1.3%. The FTSE 100 had been the thing immune. That was not down 1%, down a little bit less than that, but now the sell-off has continued. Every single sector in the red this morning. It's a tough and punishing market, really, that summer fragility. Let's talk about it and what's happening elsewhere with Bloomberg's Valerie Teitel. So Valerie, it's the turn of equities to have a bad day. Yesterday, it was the turn of bond markets for everywhere except Japan. I mean, this is not what we anticipated would happen. We would anticipate that this market would test the BOJ. What does it say to you that we didn't get that?
Yeah, that was really the most surprising thing to me this morning, not the announcement of the downgrade, but the fact that JGBs hardly really moved to that really leap higher in Treasury yields we have yesterday. It leads me to believe a bit that maybe the Bank of Japan won't be tested as much as we thought, and it'll just be a very slow, grinding rise in these JGB yields. Maybe we won't get this whole 10 basis point move, and the BOJ really has to come in and show their firepower to give some more confidence to the market. We're seeing that in JGBs today. They've just moved higher by 2 basis points, and the yen is strengthening. Yen is strengthening 0.5%. I mean, that's good news for the Bank of Japan. That's saying that the markets are maybe believing that maybe this tightening they have done is enough. Whereas the last few days, they've really thrown it into doubt, really pummeling the yen. It's weakened over 3% in the last 3 sessions.
Maybe some of that yen strength, though, is just coming from this pummeling of risk assets. Valerie, I'm looking at it. European stocks down more than 1%. NASDAQ, Russell 2000 futures down more than 1%. Hong Kong stocks down more than 3%. Global equities are really shaken this morning.
Yeah, really shaken, but you've made this point in the show earlier, Dana. It was really unclear what started it all. It really started to deteriorate yesterday, even before we got the U.S. data, same with the Treasury yields as well. We had this, equities being in the red. It's the start of a new month. People are reevaluating where they want their positions. And, Danny, it's August. It's summer trading. There's not a lot of liquidity out there. Maybe moves like this just get exacerbated a bit more. But, when it comes to the debt ceiling standoff and the safe haven bid that we thought we might see, really not seeing it very much. Gold's ticked higher, maybe 0.2%, but if you look at dollar Swiss, the Swiss is actually weaker this morning. So, a bit of confusion over where this equity weakness is coming from, but, as you mentioned, it could all just be down to positioning. It's a new month, and August trading is light.
Yeah, again, and there's this fear just because we're short vol and short the very front end of vol too. Are we positioned wrong? No one's been taking out hedges, so the fear is that potentially it cascades. Let's hope it doesn't. Valerie, thank you so much for joining. That's our Bloomberg Markets reporter, Valerie Teitel. That's it for Markets Today. You can get more insights from us and the team on the front page of the Bloomberg UK website or T-Live Go. That's where you want to head on your terminal. The Pulse with Francine Lacqua is up next. This is Bloomberg.
person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fitch strips the U.S. of its AAA credit rating, citing ballooning deficits and an erosion of governance. Treasury yields moved higher before stabilizing. Treasury Secretary Janet Yellen blasted a surprise decision, calling it arbitrary and outdated. Plus, Trump charged the former president is indicted over his efforts to overturn the 2020 presidential election, charges he has repeatedly denied. So good morning, everyone. Let's take a look at the European markets map. Everything has to do with what happened in the U.S. Investors say that Fitch's U.S. downgrade may do little to deter the top-notch status of U.S. assets over the longer term. But for the moment, we're seeing a little bit of pressure. Across the board, we're seeing down futures in the U.S. Of course, what traders are pointing to is solid growth in the U.S., but also no real alternative. Now, they're also taking cues from what transpired in the wake of a similar event in 2011 when S&P removed the highest rating for the U.S. following an earlier debt ceiling crisis. The main question is, what does positioning look like today, and where are we going to see the main pitfalls? Now, while that triggered a sell-off in risk assets around the world, it did boost treasuries in the short term as investors sought out havens. So that's something that we need to spend a bit of time on. On the surface, the U.S. is facing a huge amount of debt and interest payments, $32.6 trillion in total debt, $970 billion total interest. Both measures are at a record high. And then if you look at the average interest rate paid on U.S. debt, still well below 3%, below inflation. That means that real borrowing costs are still negative. I mean, we're lucky. We have all of the Bloomberg charts to support some of the analysis that will bring you throughout the hour. Traders also bracing for this $102 billion wave of Treasury bond issuance for the quarterly refunding announcement. What you're seeing on screen are basically dealer projections. So we'll have full team coverage, all of the reaction to the downgrade, charts analysis, and expert opinions. So joining us now is Bloomberg's Valerie Teitel, looking at some of the great charts that she's been delving into. Val, what's the consequence of all of this?
Well, Francine, I want to talk about the U.S.'s debt-to-GDP ratio and tag it to the reasons in which Fitch made this decision overnight. Fitch had three reasons that triggered this downgrade, one of them being the expected fiscal deterioration. And I want to point out that normally when we head into a recession, the government accounts do deteriorate. You can see that in 2008 and then when we headed into the pandemic recession as well. Fitch does forecast a recession for the U.S. starting later this year, early next year. So they're already penciling in a worsening rising debt to GDP ratio as we go forward. They also blamed a high and growing debt burden. Now, if we look at the median of Fitch's AAA, the U.S.'s debt to GDP is 2.5 times higher than the rest. They specifically pointed that out in their note. And then lastly, their last reason for this downgrade was an erosion of governments and an erosion in confidence in fiscal management. That is saying that if the debt to GDP ratios get to a worse level, there's just less confidence that the U.S. government can do something about it. Now, it's hard to say why they chose specifically now to make this decision, Francine, but we did have the announcement from the Treasury on Monday about third quarter borrowing. It came in way above estimates. They plan on borrowing $1 trillion in the third quarter, which is a record and above estimates. We also know that their interest payments have been ballooning. Those higher interest rates are causing interest payments to nearly run at a $1 trillion annualized pace. So these are two things that have escalated in the recent months, and it poses an answer maybe on why Fitch chose now to do this downgrade.
Yeah, Valerie, the $1 million question, thank you, or the $1 trillion question, I should say. Valerie Teitel there with all of the charts that matter. Now, joining us is Bloomberg's Markets Today Managing Editor Christina Aquino and M&G's Chief Investment Officer for Equities and Multi-Asset, Fabiana Fedeli. So thank you both for joining us. Fabiana, longer term, how much of an impact will this have on the perception or the U.S., or is actually Janet Yellen right? This is backward looking.
It is backward looking. I mean, if the timing is surprising, it is very clear what the reason for it is. This constant debacle on the debt ceiling, the deterioration of the balance sheet of the United States. Now, until the US dollar remains the base currency of the world, I really can't see an alternative to treasuries in many circumstances, besides the fact that for some collateral trades, for example, on AAAs, the US dollar will have to, or the treasuries will have to be removed. But other than that, I don't think longer term this brings much difference to the table.
Yeah, Christina, I guess the worry is that there's $102 billion in issuance, and I don't know whether at the margins, again, we're just going to see quite a lot of volatility over the next 2 to 3 weeks, especially when that huge amount of money is coming out.
Absolutely, Francine. And, adding to all of that volatility, of course, we're very much deeply into summer markets at the moment, which perhaps explains a little bit of Fitch's thinking in terms of going with the announcement now, right? If you want to make maximum impact in markets, you kind of do it when there's not a lot else going on. And that seems to be the logic at play here. But yeah, I mean, I think at the very least, what we're seeing today is kind of that immediate sentiment hit from the Fitch move, right? Well, we're seeing everything being sold off in terms of risk assets, and then havens are in play. I would note, though, that it really isn't that outsized of a reaction, particularly in bond markets, certainly not as much as we saw in 2011 when I was a cub reporter experiencing this for the first time and covering bond markets back then. I mean, I remember the reaction back then was quite significant just because it was the first downgrade by S&P. It was, they were the first mover. It seems like, a few years later or a decade later, the reaction isn't as big as maybe Fitch hopes.
I mean, is this a worry, Fabiana? If we're starting to talk about, some of these credit rating agency doing it in the week to have market impact. I mean, this is not a central bank. This is not what they're supposed to do. I mean, this usually happens on a Friday once the market are closed, and actually, so they don't make a splash and a wave on the markets.
Well, we don't really know what the reasons for the timing are, right? In the end, the reasons for this are pretty clear, are understandable. I believe a lot of investors out there have already taken those reasons into account in their investments. So again, while I very much agree that there is a first reaction, I really don't see this as lasting.
Christine, we have a big number. This is something that we're going to now do daily. We have a big number, and today our big number is $1 trillion. So the Treasury increased its net borrowing estimate for the July through September quarter to $1 trillion, more than some analysts had expected, and certainly well above the $733 billion that I had predicted in early May. So the Treasury will preview its quarterly financing plans also today, which is what we're talking about in terms of issuance. I mean, does that change their thinking in terms of how much they can borrow, or does it not really impact politics in Washington?
Yeah, it's quite interesting, Francine. I think, those plans are already in play well before what we saw from the Fitch decision overnight. So I don't really think it's going to make the U.S. suddenly reverse course in terms of borrowing plans. But yeah, I think moving forward, there are political implications here. I could easily see this Fitch move being brought up in the politics. We're heading into the election cycle. This is definitely something that the GOP can use against the Biden administration as evidence of mismanagement of the country's fiscal position. Whether or not that's true, of course, very much up for debate and not really something for us to comment on. But, at the very least, yeah, this move is certainly something that could make the politics for the Biden administration quite difficult at this point in time.
And Fabiana, if you look at the main market drivers, and we go back to central banks and inflation, of course, all the data points that we received.
Look, I think this is independent right now from the downgrade. We see the Fed be in a completely different position, for example, from the ECB and from the BOE, and for emerging markets banks. You already saw Chile last week cutting by 100 basis points. Brazil will probably cut by 50 basis points today. And the Fed is possibly close to the end of the cycle with maybe one more increase. ECB and BOE, they still have some room to some ground to cover.
Well, thank you so much. We'll also talk a little bit about currencies shortly. M&G's Fabiana Fideli and Christina Aquino going through, of course, a big story about the downgrade from the U.S. Also coming up, Donald Trump charged. The former president is indicted over his efforts to overturn the 2020 presidential election. Charges he has repeatedly denied. So we'll bring you all of the details next, and this is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back. Donald Trump has been indicted on federal charges, accused of a conspiracy to overturn the 2020 presidential election. Now, this is the former U.S. president's third criminal indictment as he makes his latest run for the White House. Now, he has repeatedly denied any wrongdoing. Well, joining us now is Bloomberg's Rosalind Matheson. So, Ros, good morning. What does that actually mean for Trump's campaign?
Well, it's interesting, this being the third indictment in 4 months that he's faced, but he's been using this to really try and mobilise his campaign, mobilise his base. He's saying particularly these charges coming now, several years after the event, are very political. He says the Department of Justice really is an extension of the Biden administration. So using this to kind of whip up his base. And he does really need to do that because he needs to raise a lot of money for all these legal cases. And those people who are giving money to his campaign are essentially now funding these extensive legal cases. But what we've seen is he's actually used these as leverage to get support. You'd think all these legal cases would start to work against him, but oddly enough, it's something that he uses to get energy from, in a way, and energize his base. And we've seen that reflected in his opinion polling. So certainly this latest legal case may not necessarily harm him in those opinion polls.
So, Ros, what happens now?
Well, he's due to appear tomorrow in court, but a lot of these cases could go for months, if not years. They could run into the election campaign next year if he does indeed get the Republican nomination. Then perhaps there's a precedent where he's a sitting US president still facing all these legal cases. He's tried to push them back beyond the campaign. He says that they're interfering with his efforts to seek the Republican nomination, but it's very likely we're going to see a series of court cases, court appearances, some of these things actually getting underway late in the piece next year, possibly right when the election campaign is reaching its peak. But certainly we expect him to appear in court tomorrow in Washington, and that's where we'll expect him to say the same things again. These are fake charges against him. He'll use it again as a moment to try and whip up his base.
Ros, thanks so much. Bloomberg's Rosalind Matheson there. Now we're back with Bloomberg's Markets Today. Managing Editor Christina Kino and M&G's Chief Investment Officer for Equities and Multi-Asset, Fabiana Fedeli. So thank you both for staying with us. Fabiana, when you look at some of the positioning that we're seeing on the markets now, you know, what feels wrong at the moment that you would change into September?
Look, what we're seeing right now is a most likely soft landing for now in the United States. You see macroeconomic numbers being constructive and supportive, less so in Europe, but you see some differences between countries such as France, for example, and Spain doing much better than Germany. So there's quite a dispersion in terms of where the world is going from a macroeconomic standpoint. What it feels like now is that we're not anywhere near a deep recession or a credit event, which means that it's probably too early to throw the towel in on risk assets. You can still stay in equities, you can still stay in credit, but just stay very high on the quality side. And that is the area where the market doesn't necessarily position itself in that way. So we have seen a resurgence of high yield trading and also some bottom fishing in equities. I would be very cautious on that.
What have the earnings told you so far?
You know, very interesting. They continue to tell us that different companies with small different tilts in exposure, with better balance sheets, ultimately better pricing power and better management, are doing much better than others, even in the same sectors. So it's really a market that continues to call for selection.
And it feels, Christine, like a lot of market participants actually look to the forecasts for the companies longer term rather than, you know, for example, margin and things like that.
Absolutely, Francine. And, you know, that future outlook for profits and earnings per share definitely still very much on the radar for investors. And I think you could understand also why some of the companies, particularly in the UK, have really been trying to mitigate against that. I mean, one big theme that we've seen over here is this theme of big buybacks, right? We've seen it definitely from the major UK banks that have reported thus far, as well as big oil. And you can understand, I think for the banks, it's definitely them trying to give investors the benefits of those net interest margin profits that they've seen over the last year or so, just before that may be starting to fade, right? And there's definitely that theme of, oh, it's the best of that margin story behind us. And then when it comes to big oil, I think what we're seeing is buybacks acting as a bit of a sugar pill for investors, because we have seen profits kind of moderate from the very, very high levels that we saw last year as energy costs kind of come down a little bit. But, you know, there's definitely this effort for companies to keep investors happy, even if the outlook's maybe a little shaky in the future.
And Fabiana, when you look at, I mean, there's David Finnerty, one of also our markets live bloggers, saying, look, it's really the U.S. payrolls number on Friday that will move treasuries more maybe than what we heard from Fitch. What's your expectation for the U.S. economy? Are we going to avoid a recession?
So it does look, first and foremost, I would agree that it's not necessarily only the payroll number, but all the macroeconomic data and the inflation numbers that will really keep these markets going or not. And in terms of what we expect from a recession standpoint, we are at a point where possibly there's going to be a soft landing in the near term, but companies and consumers will have to deal with higher for longer interest rates. So that means that spending will most likely come down, and that could bring a recession, possibly not in the near future, but definitely deterioration of numbers going forward. And we need to take that into account when we invest.
So where do you see the best opportunities? I know you mentioned Japan, but also, for example, some of the emerging markets that you say are a fertile area for opportunities.
So one of the things that we're telling clients is don't make big macro trades. Don't only look at one country. Really try to stay selective within countries and within themes. And we see some interesting companies in Japan. We see interesting companies in India. We also see interesting companies in Europe. But again, it's a very differentiated market.
Christine, oil market, or actually the oil price is going up. Does that change markets' focus at all?
Well, I think it's another factor for markets to keep track of, Francine, for sure, because again, we're still kind of dealing with the repercussions of elevated inflation and obviously oil prices feeding into that. Again, just this earnings season, the big question for a lot of companies is, are they still going to be able to wield that pricing power, right? It was all about margins. And what we're seeing on the energy cost front, very much a part of that. We have seen some silver linings for some companies saying that, input costs are a bit lower now, largely because of the lower materials and energy prices. But if that's something that's kind of come back as a risk for companies, then that could potentially change the equation for the second half.
Thank you both for joining us. Christina Aquino from Bloomberg and M&G, Chief Investment Officer, Equities and Multi-Assets. Of course, Fabiana Fedeli joining us for some great calls going forward. Now, coming up, AMD gains after the chip maker tops estimates and touts inroads in AI computing. We'll have a full roundup of what they said. That's next, and this is Bloomberg.
Soros Fund Management CIO Dawn Fitzpatrick are the exception in finance, not the rule. Morningstar has taken an in-depth look at women in the industry, and the numbers are startling. The firm found that in 2020, women made up 14% of global fund managers. That's largely unchanged from the year 2000. Morningstar also calculated that while the number of women at the top of the corporate ladder has increased, it won't be until 2060 that women will reach parity with men in the C-suite. Studies have shown that increasing the number of women managers leads to better decision-making and moderates overconfidence. European Central Bank President Christine Lagarde insists that male domination of the banking industry made the 2008 collapse of Lehman Brothers more likely. As Lagarde put it, if it had been Lehman Sisters rather than Lehman Brothers, the world might well look a lot different today.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
We're very excited about this. It's a seminal moment for Uber to deliver GAAP operating profit, free cash flow of over $1 billion just in the quarter, along with a really strong top line. You look at a gross bookings growth that was $33.6 billion.
Well, that was Uber Chief Executive Dara Khosrowshahi. They're hailing the company's first ever operating profit. Milestone was eclipsed by a pace of growth that has slowed from pandemic highs, sending the shares down the most in 9 years. Now, AMD gained in pre-market trading after the chip maker topped second quarter estimates and touted inroads in artificial intelligence computing. The announcement putting it closer competition with NVIDIA. Well, joining us now is our tech reporter, Aggie Cantrell. Aggie, good morning. So AMD has seen quite a turnaround this quarter off the back of AI interest. Is it a second NVIDIA?
Yes, Francine. So as people have been saying, in the current market, there are chips and then there are chips. And what the distinction is there is what these companies are doing when it comes to artificial intelligence. And AMD has gained a lot of interest from customers because of their efforts towards things like the AMD accelerators that are essentially able to be used to speed up the development of artificial intelligence. And retooling data centers is a big part of that. A lot of big tech companies are looking to retool their data centers so that they can commit all of this effort towards artificial intelligence, and chips are needed for that. And the likes of AMD, just like NVIDIA, are quite well positioned to do that. The CEO of AMD said yesterday that she thinks that the market for AI chips in data centers is going to be at $150 billion by 2027. So they see this as a real opportunity for them. And then also they are a big producer of PC chips as well. And just as we saw with Intel last week, they're also seeing a renewed demand in that market as well after quite a few lackluster quarters.
Aggie, thank you so much. So what are you looking out for very quickly in Qualcomm earnings?
Yes, so essentially PC demand is that thing that we're also looking when it comes to Qualcomm, when it comes to consumer tech demand, and when it comes to smartphones. Qualcomm is a big provider of smartphone chips, and we're seeing that now a lot of customers are returning to the market and looking to buy more chips for their smartphones, having had huge inventories for a long time. So the thing that investors will be looking out for when it comes to Qualcomm is making sure that they have been able to bear into the stockpiles that their customers have taken, and that as people are buying smartphones again.
Aggie, thank you so much. Aggie Cantrell there. Now, coming up, oil rallies after a report pointing to huge drawdowns in U.S. inventory. So we'll discuss that next. We'll have a full roundup of not only what's going on with crude, but also treasuries on the back of Fitch downgrading the U.S. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision. Fitch strips the U.S. of its AAA credit rating, citing ballooning deficits and an erosion of governance. Treasury yields move higher before stabilizing. Treasury Secretary Janet Yellen blasts the surprise decision, calling it arbitrary and outdated. Plus, Trump charged the former president is indicted over his efforts to overturn the 2020 presidential election, charges he has repeatedly denied. Good morning, everyone. Happy Wednesday. Welcome to The Pulse. I'm Francine Lacqua here in London. So oil has resumed a rally after an industry estimate pointed to a huge drawdown in U.S. inventories, adding to signals that the market is tightening. Well, joining us now is Bloomberg's Anthony DiPaola. Anthony, good morning. So what exactly is driving oil's gains?
Good morning. Yeah, I mean, oil is continuing to rise after having a bumper month of July. And really, this is a supply-driven market. So what's pushing up oil is the issues on supply. That's OPEC Plus cutting back production. We've got also some supply disruptions in certain areas. And so that's what's really moving the market. We are seeing forecasts on the demand side that we're going to hit peak demand, so highest ever demand this year. And that is giving some underpinning to the market. But that much waited for surge in supply from China has still not come, as that recovery is still a little bit sluggish. So it's really the supply side that we're looking at, mainly those OPEC cuts and those outages. We're talking about 500,000 barrels of oil that's still offline in Iraq due to pipeline disruption. Libya, Nigeria, and Venezuela continually vacillating in terms of their production, going up and down, and still losing some barrels there. Yeah. Plus Russia coming in with their timely cut. So that's really affecting the market, Francine.
So where do OPEC Plus and China fit into this picture going forward?
Well, OPEC Plus has said that they're going to keep their current level of quotas in place through the end of the year, so that's underpinning the market. Plus, we've got voluntary cuts on top of that, and that's coming from Saudi Arabia. They've decided to take another 1 million barrels off the market, and we're going to be seeing in the next couple days whether they continue that. They've got the market a little bit on tenterhooks there because they've said that they're going to decide on that on a monthly basis. So we're going to have to wait as we go ahead and see month by month whether Saudi Arabia continues to continue that cut. On the Saudi side, for sure, they're looking at China. We're seeing some potential signs that Bloomberg News reported overnight that demand has probably peaked this year in China. So that's going to be bad news. Obviously, that will hold up, but we won't see potentially more of a bump from China later this year. So that's those are those two factors, again, on the supply and the demand side that are affecting the market, Francine.
Anthony, thank you so much for joining us today. Anthony DiPaola there from Bloomberg in Dubai. Now, staying with energy, and today's big take actually looks at how one of the UK's biggest energy producers managed to avoid repaying £639 million to taxpayers during a historic inflation crisis. Now, the company did not break any rules, but 3 former UK energy secretaries who oversaw subsidy policy have told Bloomberg that Drax appears to have violated the spirit of its 2014 agreement. Well, joining us now to discuss all of this is Bloomberg's European power reporter, Todd Gillespie. Todd, first of all, congratulations on a really great and important big take today that we're pushing out on all of our social media channels. So first of all, explain how the subsidy deal between Drax and the UK government was supposed to work.
Thanks, Francine. So basically, since 2016, Drax, which uses biomass to produce electricity at its Northern England power plant, which is a very expensive form of fuel, it's been getting subsidies basically from taxes on consumers' bills to make sure that it can produce that power profitably relative to other companies that can make it for a lower cost. And the idea was that once the market price went above, if it ever spiked above this kind of agreed fixed price, that money, any excess profit, would basically start flowing back to consumers.
So how did they avoid that? How did they avoid paying UK consumers?
Well, essentially, they basically switched off one unit at their power plant that was on this subsidy scheme. They moved the fuel to the other units, or they sold it on the open market, where prices had spiked because of Russia's war in Ukraine, which disrupted global biomass supplies. So the company was able to nearly double its EBITDA last year on the back of this very canny trading maneuver. But secretaries of state, 3 former secretaries of state who oversaw energy policy that we've spoken to, accused the company of violating the spirit of its agreement. And it comes at a time when the company is really in talks with the government about getting more public money for carbon capture and things like that. So it's quite a politically risky move for them to do.
So what's been the response from Drax?
Well, Drax say that they used this biomass supply in other units. It had already locked in hedged supply for the other units, so it didn't necessarily have as much supply available for the units that it said, the unit that was on this subsidy scheme. But at the same time, its CEO and its CFO have publicly said in earnings calls with analysts that the company has sought to optimize its strategy, regardless of the impact that it's had on consumers during this crisis.
So, Todd, Ed Davey, who negotiated the company's subsidy deal as Secretary of State for Energy and Climate Change, did not mince his words. I mean, this is gaming the contract, he said.
I mean, that's the argument. I mean, these contracts were really designed, after years of having just one-way subsidies. Consumers would just top up companies, and there'd be no necessary payback for consumers afterwards. And the whole idea was that this was a two-way deal, and Drax essentially was able to opt out of that two-way deal once it did this, and at a time that was really critical for consumers.
Todd, thank you so much. Great reporting, and of course, a great story that everyone should read on the Bloomberg terminal or on our website. Bloomberg's European power reporter, Todd Gillespie there. Now, don't miss our coverage also of the Bank of England's latest policy decision tomorrow. The decision due at midday UK time with a press conference 30 minutes later. It's interesting because, of course, this is a decision on knife edge, 25 or 50 basis points. We'll, of course, also be covering all things UK every week on Thursdays, 9:30 a.m. London time in our half-an-hour special. Tomorrow, we're looking at the future of the UK housing market, and this is Bloomberg.
Young person who might like to have a career like yours, what would you recommend? How can you prepare to be the national security advisor or to serve your government in some way?
The biggest piece of advice I try to give young people is to reject certitude. What I mean by that is that no matter how good you think your argument is, or your policy position, or your proposed course of action, it almost certainly has weaknesses or blind spots, and you should acknowledge those. I think actually sometimes saying, you know what, I was wrong, you were right, is actually a more powerful show of intellectual strength than just sticking firmly by your position. Doesn't mean you should compromise your principles or your values, but the easy decisions do not rise to the White House. The hard decisions do. And those hard decisions have two sides that are not 100-0.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. It is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. So Fitch has stripped the U.S. of its top-tier AAA sovereign credit grade. Reasons behind the downgrade include ballooning deficits and an erosion of governance. Well, joining us now to discuss is Jens Nordvik. He is founder and chief executive of Exante Data. He's also one of the most well-respected Wall Street voices. So I'm really happy that you're in London by chance this week, Jens. Thank you so much for joining us. I don't know whether this has longer-term effects or whether you take 2011 as a template and say, look, there's no real alternative. The U.S. is not going to default. It doesn't really change that much.
Yeah. I think when we analyze this type of downgrade, at least from a short-term perspective, we think about, is there anybody who has to sell anything as a function of this change? And I think in 2011, that would have been the case. There were entities that could only hold AAA assets, or they had to give AAA assets as collateral. But that has really changed in that period since. We tried to do the numbers again last night. Like, it's very hard to find funds, entities that are excluded from other stuff than AAA. So I don't think there's going to be a lot of forced selling, right? So the question is there some kind of sentiment shift that's going to happen as a function of that? Clearly, it's not good news. But if we look at the initial market reaction, pretty moderate reaction in the bond market, pretty moderate reaction in the currency market and in the equity market. But the equity market was perhaps already starting to be a little bit shaky before this news come out, and maybe that's continuing to
But yeah, so there's 102 billion coming up for issuance in the next 10 days.
Yeah.
Does that change appetite?
So I think the problem with the U.S. bond market is that even before this news, we had a kind of flow situation that was starting to look pretty shaky. Japan have their own kind of bond issues. They've stopped buying U.S. bonds over the last 3 weeks. Bond funds in the U.S., we track them one by one. They've already been buying a lot of bonds over the 9 months, and they kind of probably have more limited capacity to really add to that. So what we've seen over the last couple of weeks is that in the absence of any bad news, yields are drifting higher. And we've even seen that in the last couple of days. Now we have the funding announcement coming later today, right, where a lot of bonds are going to be issued. So it was already shaking, and clearly the news we've had today is not going to make appetite for buying U.S. bonds particularly strong.
But so, yeah, where's the biggest mispricing when it comes to global rates market?
Well, so I think after we had the U.S. CPI print that got everybody excited that maybe the Fed can start to relax a little bit, we started to price very aggressive rate cuts. If we look at 2024, we had 150 basis points priced. That's not really what the signals from the economy are showing, right? Okay, maybe headline inflation is coming down. Labor market still looks very robust. Every time I speak to CEOs or something like that are hiring in the U.S., they always tell me the labor market is tight, right? So it's hard to see the Fed being forced to cut rates aggressively unless, you know, financial conditions take a big turn down.
So what cuts are for 2025?
Yeah, I think that's a long time frame. Over that time frame, right, what is happening over time is that more and more people who have to borrow are rolling into these higher rates, but it doesn't happen from one day to the other.
But so if you look, so let's talk about the Fed just stopping hiking, right? Not talking about cutting. What are the currencies that benefit and lose the most just from that immediate effect?
So what we've seen over the last couple of months is that it really depends a lot on what risk sentiment is, right? So you can do kind of emerging market currencies. Emerging market currencies actually had a really great run during this period where the U.S. equity market was doing very well. So we talk about the strong dollar, but actually LATAM currencies were even stronger. And then in those periods where the equity market turned, you have the yen and the Swiss franc. So it really depends a lot on what risk assets are doing. And that's what we've seen over the last couple of months.
So going back to BOJ, what's the biggest impact actually of that shift?
Well, I think we actually get data today on what is the weekly flow in and out of Japan, right? And as I mentioned earlier, we've already seen over the last 3 weeks that Japanese investors are not putting money into the US bond market anymore. And Japanese fixed income investors are very important in global fixed income markets and the US market, right? So if they stop that because they now have higher yields domestically, that I think is an issue if the US bond market is already looking a bit shaky. So I think that's something to watch very closely.
Do you think that actually the end of yield curve control is a given? And by when?
So I think effectively the yield curve control is already dead. So now it's just a transition phase where they smooth the transition to a new regime. But I think it's already been abandoned. It's the right decision, right? And now it's just a matter of how quickly do they allow the yield curve to actually adjust to that new reality.
Are you, I mean, this is a question that we could talk about for like 5 hours, right? If you look at inflation, how are you, are you sure that central banks are not getting it wrong again? Inflation doesn't spike back up?
I have a lot of clients that crunch CPI numbers in intense detail, and I think amongst the ones that really go into the detail, there's sort of a consensus that the next couple of prints are going to look okay.
Yeah.
And then when we get to Q4, the numbers are going to be higher again. That's another argument that it's going to be hard for the Fed to actually cut in 2024.
But what does that tell us? Like, it's unclear. I mean, these patterns, is it because of COVID? Is it a tight labor market? Is it structural forces that we don't understand?
I think when you look at what's going on with inflation globally, we don't have goods price inflation anymore. Over the last 4 or 5 months, we've essentially had goods prices flat, not just at 2% inflation target, but below. So that problem has kind of gone away, and the remaining problem is wages still going up more than is consistent with target, and the services prices following. But that also depends on which country you're looking at, right? So those economies where the services sector is big are going to facing that problem. The other economies where that's less of the basket and perhaps they're more linked to China actually have a different inflation dynamic now.
But so you're expecting, I mean, this is worrying, right? Because you could have a situation where inflation's picking up again, but actually interest rate hikes are starting to have an impact on the economy.
It's not easy to be a central banker, right? Because of the
or a market participant, frankly.
No, you could say that too. The central banks have like a real tension between inflation that is still way above target on services, right? And then growth starting to turn. In the last 15 years, we have been used to a regime where as soon as growth turns, we got easy policy, right? And I think this is the real tricky bit. It's the same for the ECB, right? A lot of people are looking at PMIs turning over, but I don't think it's going to be so easy for the ECB to stop if core inflation is still printing way, way above target.
Jens, thank you. Jens Nordvik, he is the founder and chief executive of Exante Data, and he, of course, stays with us. Now, the conversations that matter, the insights you need, will continue with Jens, and we'll talk even about the UK and the Bank of England tomorrow. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back. Still with us, Jens Nordvig. He is founder and chief executive of Exante Data. Jens, we talked a little bit, first of all, thanks so much for sticking around, but we talked a bit about the BOJ policy shift, yield curve control, talked about inflation and treasury. When you look at real yields, are they sufficiently restrictive in both the US and Europe, or do they still have further to go?
So I think this year, like if I was going to say one key word for the whole year, it's credit, right? So I spent a lot of time on looking at credit dynamics globally. And we can see credit dynamics are slowing quite dramatically in Europe. ECB has commented on that as well. In the US, credit dynamics are slowing, but I think people are a little bit surprised that they're not slowing faster because they thought there was going to be a massive shock from Silicon Valley Bank. To finish off with Bank of Japan, they're actually seeing the opposite. Credit growth is quite strong in Japan, which fits with their real rates not being high, right? So monetary policy matters, and you can see it in the credit dynamics around the world.
What's your biggest worry about Europe? So I know you mentioned PMIs that could be a little bit wobbly going into next year, but we're also seeing, I guess, spending not having such a easy trajectory that maybe some economists had thought.
Yeah, I think the concern for the economic outlook is often linked to what's going on in the labor market, right? So the labor market has been holding up quite well. Like when we look at hiring, we still have respectable hiring in many Eurozone countries. Unfortunately, the data comes out very slowly in Europe, so we don't have as good data as we have in the US. But I think that's what would concern me. If that weakens further, I would say, okay, we're heading into a very tough time, but it's not at that point yet.
I know you like looking at quirky charts, which is why I love following you actually on Twitter as well. If you look at income and expenditure, side estimates of U.S. output growth, and there's a paper from Brookings Institute, I don't know whether there's, a divergence, for example, that we're seeing in GDP growth and GDI growth that we need to pay attention to. Is there something that you're paying attention to which is off the beaten track that gives us a glimpse of what we should be looking out for?
Well, so I think related to essentially who makes the money, are we having increasing inequality? All those things are tied, right? So we have a situation now where there's a lot of focus on AI in the market and other places, right? And I think the concern with those accounts is that we're going into a phase where increasingly the extra value added in the economy will be derived from some very big companies, and that's going to skew the income distribution even further and not be good for demand going forward. So I think that's what to watch for in that data right now.
Are central banks aware of this? Or, I mean, is there a blind spot actually that you're seeing that could make them take a wrong decision?
I think central banks are reluctant to take strong views on these new trends until they can see clear evidence of in the data. I think there's going to be a debate about, how's our star going to be impacted by this stuff, but it's too academic for them to set policy on it. to be honest, policy is going to be very much a function of what the core inflation is in the next couple of months, because they don't trust their forecast that much anymore, because they've been very wrong for 2 years now.
How difficult is it being a Bank of England official right now? So they have a decision tomorrow, 25 or 50 basis points. It's kind of on knife edge, but it's also a lot of complexity. I mean, they even drafted Ben Bernanke to have a look at forecasts.
So Bank of England is facing a very tough situation, right? We know the high interest rates are going to be causing serious issues for mortgage holders as those reset. But in addition to the underlying challenges, I think they've also created some challenges for themselves with, I would say, pretty erratic communication, kind of a bit stop-go with the pace of tightening. So that's going to be a tough communication. I think they're going to try to be quite hawkish, but not continue with the 50 basis points. So it's going to be a weird mix. They're going to have to, again, explain their forecast, which comes out of a model that not a lot of people have a lot of confidence in. So not an easy job they have on their hands.
I mean, talking about models, you're founding another company because you're not busy enough, looking at like algorithms and basically what are you trying to study that you think is lacking in the market?
We're trying to solve a very simple problem that essentially everybody in the market has. We want to understand, why is the market moving? Markets are complex, right? So it's not such an easy thing to answer all the time. So we want to attack that with a lot of data across a lot of different dimensions and really give people an objective, real-time answer to why we have gaps in the markets for stocks, macro assets, and so forth.
And you think, is there more of a gap with what markets are doing than what the economy's doing? Because the economy, I mean, we've read the economy wrong on multiple occasions for multiple years.
Well, so in the new company that we're launching called Market Reader, our focus is to give objective explanations of what is happening. Okay. That could be tied to economics, it could be tied to something else. Anything that we think is relevant will be surfaced.
So send your questions to Jens on Twitter and he'll answer them for you. Jens, thank you so much, as always, for joining us. Jens Nordvik, there, founder and chief executive of Exante Data. Now, tomorrow, don't forget, we also kickstart our coverage from the Aspen Economic Strategy Group. A host of policymakers and executives will weigh in on solutions to the biggest issues affecting commerce in the U.S. and elsewhere. Also tomorrow, it's Bank of England. We spoke about it with Jens. And then we have a special show dedicated to the Bank of England. And then after the press conference, I'll also be speaking to the governor, Andrew Bailey. Now, up next, the Bloomberg Surveillance Early Edition with Kriti Gupta in New York, Danny Berger in London. They'll continue market checks. Our main story, of course, what happened overnight, or actually late last night, I would say, the U.S. being stripped of its AAA rating by Fitch, of course, as budget deficits are swelling. This is Bloomberg.
Of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Fitch strips the U.S. of its AAA credit rating, echoing a move by S&P more than a decade ago. The decision draws criticism from Larry Summers and Mohamed El-Erian. Treasury Secretary Janet Yellen calls it arbitrary and outdated. Former President Trump charged. The former U.S. president has been indicted in Washington on federal charges over his efforts to overturn the 2020 presidential election. But in the midst of all of that drama, earnings season rolls on. AMD rises on AI optimism while Starbucks slips on disappointing sales. Welcome to Bloomberg Surveillance, the early edition. I'm Danny Berger in London with Kriti Gupta in New York. Kriti, it is ugly out there. It looked to have started with perhaps the Fitch downgrade, but at the moment, equity markets seem to be spiraling into something else.
Yeah, they really are. But look, it's not a similar reaction across all asset classes. Danny, the last time we had this kind of downgrade from S&P, about, 12 years ago in 2011, you saw this massive bid into the bond market, essentially being that even the irony that the U.S. government may not be as safe as before, it is still the most safe in the world relative to all the other countries. So naturally, in a crisis, if the world's going to end, you still buy U.S. Treasuries. That is not the same dynamic that is playing out in today's trade. So even though we are seeing this massive sell-off this morning, futures down almost, pairing some of their losses, but down almost 1%. NASDAQ 100 futures really taking a hit there, down about 1.2%, again, off of their lows from that pre-market trading. The bond market is seeing a bid, but only on the front end of the curve. Go out to the 10-year and you aren't seeing that same bid. In fact, 402 out on the 10-year. And I think that's pretty significant, Danny, when we talk simply about this allocation of just how much panic is there. Is this, at the end of the day, an equities positioning story?
I think that's a really good point because in terms of equity land, we're really short vol right now. We basically don't have any hedges. We've talked about this before, how cheap hedges are, which suggests no one's buying them. We're positioned on very front end vol short. We're not really long further out. So what happens if this gets worse? Could it snowball because of positioning? Here in Europe, we're seeing the sell-off, the worst sell-off in about a month. Europe Stock 600 down more than 1.5%. FTSE 100 doing even worse, nearing the 2% decline target. In Europe, we've had a whole lot of earnings. That doesn't seem to matter today. Every single sector is into the red. If you look at what's leading us down, it's growth stocks. It's similar to what you're seeing in the U.S., Kriti. You pointed this out with what tech is doing. And growth is the best performing factor year to date. So maybe it is taking profit on some of the winners, some over positioning that today we're using this volume as a chance to correct for that. One of the interesting things, I just want to point this out, because the yen is doing well today. That haven bid, it's not the same here in Europe. The Swissy is falling. The Swissy is weakening. The dollar outperforming by 0.2%. Now, it might be some eco data. Switzerland's PMI manufacturing came in at a 14-year low, so the Swiss economy not looking so strong. So again, it's not necessarily a logical market today, Kriti.
Yeah, a lot to digest, certainly. And to your point, Danny, it really all started with that Fitch news, that credit downgrade. It has been swift. Investors weighing the ripple effects. Take a listen to what some of our guests on Bloomberg had to say about the decision.
I disagree with Secretary Treasury Yellen's notion that this was arbitrary.
Look, the Fitch rating downgrade came as a surprise.
There's a few things that do surprise us a little bit in terms of their estimates.
There is a governance problem, and that is truly a problem that we'll face going forward.
This comes at an economically sensitive time, but I think this is the last thing that Yellen really needs. But from a market perspective,
the U.S. economy continues to show resilience. I think markets will just brush off.
Now, of course, we know that the U.S. has had its debt problems, but there was a lot in Fitch's reasoning. Joining us now is Bloomberg's Valerie Teitel. Walk us through everything Fitch kind of touched on when it comes to how they came to this conclusion.
Sure, Kriti. I urge everyone to take a look at the announcement by Fitch and read it, because it was really just in that first paragraph in their announcement. They labeled 3 key things that triggered this decision. One being the expected fiscal deterioration over the next 3 years. They cite tax cuts and those spending packages specifically. Secondly, a high and growing debt burden. They do spend a lot of time talking about the debt to GDP ratio as well as the swelling deficit. And lastly, the erosion of governments and confidence in fiscal management. As they noted, it has manifested repeated times in debt limit standoffs and last-minute decisions.
Why now, though, Valerie? Because this has been the criticism. The debt ceiling drama has passed. The economy is on solid footing. So why would they do this downgrade now?
No, you raised some great points, Danny, especially if we look at the 2011 example. S&P's downgrade came days after the debt limit was concluded back then. And you're right, the U.S. economy is growing very, very strongly. It's really hard to say why they chose now, but Yellen out calling it a arbitrary and outdated decision. She says that, yet we need to look at what the things the Treasury has announced just this week. On Monday, they announced that third quarter borrowing is hitting a record high. $1 trillion of Treasury issuance now expected for the third quarter. That was way above estimates. And it was only a few weeks ago that we saw those annualized interest rate payments nearing $1 trillion for the U.S. government. So, you know, you can say that Fitch does raise some good points, but it's not necessarily anything new and fresh. But perhaps we should be congratulating a ratings agency for being forward-looking instead of backward-looking in that manner.
Yeah, learning their lesson 12 years later, perhaps. Valerie, talk to us again about, you made that comparison to 2011. You're not seeing the same reaction in the bond market here. Walk us through kind of the market fallout when it comes to maybe what the logic is here in terms of trading this.
Yeah, and I want to bring up what Mohamed El-Arian said in response to this, because I think it's really telling what the markets are doing this morning. He said that the market is much more likely to be dismissed than have a larger impact on the U.S. economy and markets, and that is exactly what we're seeing this morning. Yes, we're having a risk-off tone in the equity markets, but a lot of that was baked in before this announcement even hit yesterday. There really isn't a big bid into any safe haven assets. I know Danny just pointed out Swissy there. The Swissy is actually weakening today. We're seeing a tiny uptick in gold, up 0.3%, but really not this big safe haven bid that maybe you would expect given what happened after 2011. And then even if we take an eye over to the Treasury market, 10-year yields basically unchanged on the day, Kriti. Now, maybe it's ill-advised to compare the market reaction today versus what happened in 2011, because in 2011, it really came days after the debt limit standoff was concluded, and it was the first time the U.S. had seen the downgrade. So perhaps, you know, the second time around, the market just shrugs it off even more, and, you know, it essentially doesn't change any investors' long-term view on the market. And maybe at the end of the day, this decision will be, you know, frankly, irrelevant.
It's worth pointing out that the next debt limit standoff, by the way, January 1st, 2025, about 7 to 8 weeks after the 2024 presidential election in the U.S. side, which also coincides with the lame duck session in Congress. So we really are setting ourselves up for a lot of struggle ahead. Valerie Teitel walking us through all of the market moves. We thank you as always. And we go from the debt story to the political story. Former President Donald Trump has been indicted on federal charges over his efforts to overturn the 2020 presidential election. Special Counsel Jack Smith announced the charges yesterday.
In this case, my office will seek a speedy trial so that our evidence can be tested in court and judged by a jury of citizens. In the meantime, I must emphasize that the indictment is only an allegation and that the defendant must be presumed innocent until proven guilty beyond a reasonable doubt in a court of law.
Joining us now, Bloomberg's Mark Champion, senior reporter for international affairs. Mark, look, we've been following Donald Trump's kind of legal issues for a while now. Why is this time different?
Well, you know, there are two things to say there. So politically, it isn't clear that this time will be different. He's going to be, you know, have to appear in court very soon. And, you know, these are big charges. And they come on top of a series of other cases. And until now, at least, these cases, if anything, appear to have helped him politically. So he is way ahead in the, you know, polling for the Republican primaries. And, you know, we don't know that this will be any different. You know, what has happened is essentially that, you know, the country is divided into two camps, one of which sees every new charge as evidence of Trump's, you know, ill-doing and unfitness for the presidency, and the other sees every new charge as further evidence and proof of a conspiracy by some kind of deep state to exclude him from the presidency. So it's not clear that this will be you know, different politically. In you know, legal terms, you know, this is a really interesting case in the sense that it's basically a case saying here it is a crime to undermine democracy in the U.S. and to do so through lies, deliberate lies. And that's what he is accused of, a conspiracy through lies to undermine and to upend the election results.
Now that we have this indictment in hand, what follows on the timeline as he also faces a series of other legal challenges?
Yeah, he has a number of other challenges. You know, September the 1st, by September the 1st, there may be a new case. This is in Georgia, again, about, you know, the election result in 2020. You know, all of this is going to happen during the presidential election campaigns. And therefore, it will be deeply, deeply political. Also, it will have a financial impact. It's expensive. He's already spent more than at least $25 million on defending himself in these cases. That money will take away from his campaign. He raises it, you know, through his campaign funding, and that money is being diverted. So, you know, while President Joe Biden, you know, is able to sort of build up a war chest ready for the election campaign, doesn't really have to deal with a primary. You know, Trump has to both deal with the primaries and he has to pay for his legal fees for these cases. And that could have a real impact in emptying his coffers by the time it comes around to fighting a presidential election campaign.
So that's the Trump story. Let's get to the Biden story as well. The Financial Times reporting that Biden will be asking Congress to fund arms sales to Taiwan via the budget that they've set aside for aiding Ukraine. Mark, talk to us about the ramifications if that does indeed come true.
Yeah, I mean, you know, so already it's quite, you know, it's becoming politically controversial in some quarters. the amount of weapons. Sometimes that's, conflated with money. But ultimately, it will end up as money, as all the weapons need to be replaced, and that's being sent to Ukraine. So once you start then, diverting that in order to get spend on Taiwan, it becomes even more complicated.
Okay, Mark, thank you very much for that. That's Bloomberg's Mark Champion. Coming up on the show, an exclusive interview with Stefan Karen, BlackRock's head of European private credit, as they close a major deal, and more on the Fitch fallout with SocGen's global chief economist Klaus Baader still ahead. And we'll continue to monitor the markets. Your S&P 500 futures session dips further, down 0.8%. European stocks down more than 1% as bonds and dollar are bid. This is Bloomberg.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. BlackRock is looking to become a one-stop destination for private markets, a more lucrative area of finance than just bonds or equities. Now, as part of that push, the firm has now closed its acquisition of Kreos Capital overnight. Kreos, a London-based private debt manager, has committed more than $5.6 billion in deals since its inception in 1998. Joining us now is the man behind that deal, an exclusive interview with Stefan Karen, head of European private credit at BlackRock. Stefan, thanks so much for joining. Look, this deal is interesting because it's not plain vanilla private credit. You're looking at venture debt at this moment. Why venture debt and why now?
Yeah, look, we think that venture debt in Europe in particular is a very attractive area. It's still very much underdeveloped compared to the US, right? If you think about the venture debt market, it's about a $57 billion market. Europe is only 10 to 12 billion of that, but Europe is growing 40% every year. And this is probably an attractive entry point into the market, given everything that's happened into the broader banking system as well. So we're very excited to acquire the platform. They obviously, as you said, have a 25-year track record that's tried and tested over the cycle as well.
It makes sense for a venture company going and seeking debt right now, Stefan. As you point out, SVB is no longer around. There was a UK arm of that too. The volatility there, valuations have fallen, so maybe you don't want to do a down round in terms of funding. But behind all of that is a difficult macro backdrop. Again, if valuations are falling, with this sector as a whole, how concerned are you about default risk?
Yeah, look, defaults in aggregate are likely to rise, right, across the broader economy. But what we see is that those defaults are really centered around the more cyclical sectors. I think what's important when you think about portfolio construction is to focus on the more defensive sectors. So we think of healthcare and software and technology as areas that are generally insulated against those economic cycles. And those businesses tend to resist better in times of higher economic volatility.
So does that mean with Kreos, you'll only be looking to do non-cyclical deals?
Not exclusively, but I would say the majority of the portfolio historically has always been centered around healthcare and software and technology, and we certainly intend to continue to do so. At the same time, we believe there's a very attractive opportunity set that's developing around transition, sustainability. A lot of these companies are still earlier stage. There's obviously a lot of venture capital money supporting these businesses, and then inevitably there will be some, very attractive business model that will emerge from that theme.
Well, Stefan Kritigupta in New York here, talk to us a little bit about the size of some of the folks that are involved in the competitive sphere right now, specifically when it comes to M&A. If you look at the smaller credit firms, how successful can they really be in this environment, or do they kind of have to hitch their wagon, for lack of a better term, to a bigger player like BlackRock?
No, that's a good question. I think what we see is that generally LPs are looking to consolidate their relationships with fewer managers, and that will obviously drive a certain level of consolidation. The other theme that we're seeing is that there's more and more complexity in managing these strategies, in particular when it comes to Europe, right? You need origination in the local countries, and it's very difficult to open up an office if you don't already have the infrastructure. And therefore, the bigger managers are better equipped effectively to manage these platforms, and that will inevitably drive ongoing consolidation across the private debt space.
Well, speaking of that ongoing consolidation, are you looking to expand further into private credit via M&A or through other ventures?
Well, BlackRock has very ambitious, growth targets for its private debt business, and we will look at a combination of organic and inorganic, right? Where there is an opportunity to grow organically, of course, we will do that. If the inorganic play is a way to accelerate our entry into the market, then we will consider that as well. But as always, it has to be the right target at the right price with the right culture as well, right? All of these aspects are important. These are people businesses. And therefore, it's important to find the right team with the right fit with the BlackRock model.
To that point, Stefan, when you were looking around for deals, and you're still, as you say, currently looking at this area, are there a lot of small private credit firms up for sale right now? Are you spoiled for choice?
Yeah, look, I would say, of course, that there are always smaller private credit firms that are looking to be acquired, and we expect that will be an ongoing trend. We are not going to look to acquire in areas where we already have a presence, right? So when you think about direct lending, credit opportunities, or special sits, these are areas where we already have a well-established presence, both in Europe and the US, and we have a team that we're building in Asia as well. I think acquisitions could make sense in areas where, we don't have an existing presence. But again, we don't always look at acquisitions as the only route to enter the market. The organic route,
where would that be?
Instances might be the better route.
Stefan, where do you still see the gaps there that you'd want to fill in for?
Look, there's a lot of areas within the credit spectrum that BlackRock are not active in, right? When you think about asset-based lending, secondaries, there's various asset classes. And again, it's not to say that we will acquire a platform in those particular asset classes. But of course, we like to understand, we like to look at what is available and, what markets present the most attractive entry points, both in terms of growth rates, in terms of profitability, in terms of the level of fragmentation, and how we can get to scale.
Look, there's a lot of competition in this area, a lot of dry powder, a lot of money being raised, put to use. And in that, it makes sense. I mean, if you can get a 12% yield on private credit, why wouldn't you go there? 12% is great for investors. But what about corporations right now, Stefan? Can they handle rates and a higher for longer rate environment?
Yeah, look, I think obviously you have to be careful as to how you incorporate debt into your capital structure, right? We believe in the current environment, it's important for companies to give themselves a little bit more of a margin of safety with lower leverage and, you know, to allow for slightly higher interest cover effectively. Because as you said, 10 to 12% is quite high. Now, in a venture debt space, it's slightly different because the yield components are actually a mix of you know, interest and also what we call yield enhancers in the form of warrants and equity kickers, right? So it doesn't all impact the P&L of the company, if you like. A lot of it is actually back-ended and, you know, will materialize as and when the company gets sold.
Stefan, let's broaden out a little bit and zoom out. There's a lot of debate right now in the market of whether there has even been a landing of any sorts, forget a soft or a hard landing at that point. In all of those scenarios, what would perhaps hurt the credit markets the most?
Look, I think generally private markets are generally insulated against the broader economy. Of course, you will have, you know, some differentiation among managers. What we see is in the current environment, if you're focused on investing in defensive sectors, like the ones that I mentioned previously, like healthcare, software technology, professional services, generally those portfolios will be better insulated, right? Where we see a lot of stress at the moment is in the more cyclical sectors, like the construction sector, the retail sector. These are obviously the sectors that are getting hammered with the current economic environment. And of course, this is not the time to be investing in cyclicals, right? This is the time to be investing in defensive businesses. But clearly, there will be some differentiation among managers, and I think that's a good thing. This asset class still hasn't been tested through a proper cycle. This is the time when, you know, managers will be tested, and LPs will have the choice between the better managers and those that maybe have a little bit more risk in their portfolios.
But Stefan, it's, I mean, economics and markets 101 that the private markets lag the public market. So if you are as perhaps bearish as some of the folks on Wall Street are, especially when it comes to cyclicals, at some point there is an expectation that's going to hit the private markets as well. Where do you see that read through?
Yeah, look, generally, private debt portfolios are not as skewed towards the cyclical sectors, right? If I look at our own portfolio, we have no exposure to cyclicals whatsoever. However, the public markets are generally reflective of the broader economy, and therefore you will have more risk. The other aspect that's positive about the private debt markets is that deals generally have covenants. And when you have covenants, you can actually take action before the company faces a payment default. And then the third aspect that's very attractive about private debt is that you're generally a direct lender to the company, and therefore you have the CFO and the CEO on speed dial. And again, that will allow you to engage well before the company has a problem. That is more difficult with public securities, where typically you're in a broader club. So I would think that generally private markets and private debt in particular should fare better in a more challenging economic environment.
Well, to that point of covenants, Stefan, we saw especially during COVID and before COVID and after, a lot of cov-light covenants getting put through, so less restrictions there. I assume that's what you're talking about when you say that there are some managers who won't do well through a period and that we have yet to be tested in a proper cycle. Stefan, two parts here. Do you think we're going to get that proper test? Is it coming up? And what exactly will that shakeout look like?
I think it is. Look, inevitably, you know, some of those companies that have cov-like structures will be tested through this cycle. It's hard to tell what that will imply, right, in terms of actual default, because we've never seen that yet, right? In the previous GFC, private debt was a really, really tiny market, right? It was only a $5 billion market. Today, it's a $1.5 trillion market globally. And therefore, you know, we have yet to see what the implications are going to be. But we know from experience that companies that have covenants, companies that have lower leverage, and companies that are managed more conservatively generally perform better in a slowing economic environment.
Stefan, I'm afraid we're going to have to wrap it there. Thanks so much for joining us. Let us know when you've done another deal. Come on, join Kriti and me again. We'll have you anytime. BlackRock, Stefan.
Thank you very much.
There. Thanks again. Now, coming up, we're going to speak to Klaus Bader, SocGen's global chief economist, as we sort through the implications of Fitch's downgrade. That's next. This is Bloomberg.
geopolitics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that
it.
Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fitch strips the U.S. of its AAA credit rating, echoing a move by S&P more than a decade ago. The decision draws criticism from the likes of Larry Summers and Mohamed El-Erian. Meanwhile, Treasury Secretary Janet Yellen calls it, quote, arbitrary and outdated. Meanwhile, former President Trump has been charged. The former U.S. president has been indicted in Washington on federal charges over his efforts to overturn the 2020 presidential election. And even in the midst of all that drama, geopolitically and otherwise, earnings season rolls on. AMD rises on AI optimism, while Starbucks slips on disappointing sales. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest. Earnings cycle, geopolitics, domestic politics, but really that Fitch downgrade seems to be taking the cake.
Yeah, I was going to say all that other stuff you said. I'm not sure we care about it today. Honestly, I'm not sure how much of this is even about the Fitch downgrade anymore by this point, because we're already risk off before it. It did get worse, of course, after the Fitch downgrade, but it seems like we're kind of moving into something else, perhaps moving on positioning, unwinding very popular positionings for the year. We're off the lows for European equities, but we're still down significantly. So far, the worst day in about a month, down 1 1/3% for the Europe Stock 600, FTSE 100, that's doing worse, down 1 1/4%. A lot of the higher beta type industries are doing poorly, but every single sector, if you run GRR Go on the Stock 600, you'll see that every sector is in the red today. And just to point to, Kriti, how it's mostly a stock story and everywhere else it's a little bit confused, the Swissy isn't getting a bid. You'd assume that havens would be doing really well today. Sure, gold is slightly up, the yen is slightly up, but the Swissy is weaker today, weaker by 0.25% versus the dollar. There was some bad Swiss economic data, but again, usually this pair moves more in a macro context, so perhaps our worry really is confined to stocks.
I mean, it seems to be, at least on this side of the Atlantic, you are really seeing the pain in the equity space. I mean, futures down by 0.8%. I will say they are off their lows, though. But then if you kind of zoom into the tech space specifically, the NASDAQ 100 futures, way more pain, down about 1.2%. It really all comes down to that idea of the Fitch downgrade. But to your point as well, positioning is going to play a good part of it. And I think a good way to gauge that is what you're seeing in the bond market, which is not the same kind of carnage that we saw perhaps in 2011. Simply this idea that the front end of the curve is seeing a bit down, about 4 basis points, 486 on that note. Go further out into the curve, that 10-year yield, which, by the way, in 2011 saw a massive bid on the S&P downgrade. This time, virtually unchanged, which really speaks to the idea of how much weight does this move really have on the bond market, Danny?
Let's get more to that move with the downgrade and cover it more. The U.S. sovereign credit now has 2 AA+ out of 3 major credit graders. Only Moody's has the AAA left. From Larry Summers to Mohamed El-Arian, the reaction to the decision has been one of dismissal, that it will have a lasting impact. At the same time, Treasury Secretary Janet Yellen called it arbitrary and outdated. To that criticism, here's what Allianz chief economist Ludovic Sabran had to say in response.
I find that fascinating as a European because, you know, Americans flock together when there is a decision against them. So it's super bipartisan. The same people that have been calling the overheating of Bidenomics, or people that have been, you know, quite respectful of some independence of some agencies are saying, no, you guys are wrong. You know, we're right. I think Europeans should learn a thing or two about this because, to be fair, when we have similar credit events, we tend to self-flagellate a lot more. So I think it's, you know, from this side of the pond, it looks like, you know, you guys are actually very united in this situation of, you know, not great fiscal situation, but at least you're just telling Fitch that you don't care, which I think is quite amusing.
I absolutely love that response from Ludo. The unity of Americans saying that they don't care versus the humble Europeans. Joining us now is Klaus Spotter, Global Chief Economist at SocGen. Klaus, I'm sure you know a thing about humbleness among Europeans in the face of sovereign downgrades. Look, but I do wonder how much you look at the criticisms of this Fitch rating and just kind of chalk it up to, as Ludo kind of said, American bluster versus, you know, Fitch actually is right with this decision. It makes sense. Where do you stand on it?
Well, yes, I think it does make a certain amount of sense. You know, if a country again and again threatens to go into default because it can't sort out the politics, then I think it's very difficult to maintain a AAA rating. It's as simple as that. You know, public sector debt has, of course, gone up very sharply. Longer-term prospects for public sector debt are poor in pretty much all advanced economies and in many, many emerging economies. They're just... the credit worthiness is just not that great. And I think it's a kind of a belated move. But frankly, you know, with a history of credit agencies, I have to say, I never look at credit ratings.
I was going to say, I mean, their view, the public view of credit rating agencies isn't that great at this moment. The timing of this certainly won't help. But when it comes to the fiscal standing of the U.S., with a ballooning fiscal deficit, how much impact will that actually have? We can look and say it's not great, but does it spill over into something worse?
Well, we haven't seen it yet, right? I mean, bond yields are still pretty low, both in nominal and in real terms. So no, I don't think we've seen that yet, but it's, you know, one of those things like current account imbalances is this slightly silly saying, you know, they don't matter until they matter, and when they matter, that's pretty much all that matters. At the moment, no, I don't think that that markets really are particularly concerned about sovereign ratings. They are, of course, concerned about defaults going forward in private companies, that's for sure. I mean, our credit strategies are pretty negative.
Well, Klaus, in terms of the tone that it sets, I mean, can we fast forward a year from now? I mean, this was one of my big fun facts of the debt standoff that we last went through, which is in about a year, January 1st, 2025, after a presidential election, which is already going to introduce a lot of volatility into both the economy and the markets, you find the debt standoff there again. Is there any way for the U.S. economy to kind of deal with that ahead of time, or is this an inevitability in just 18 short months?
Well, I'm not sure, because it's completely a political decision, but I find it, you know, peculiar, just like President Biden, I think most previous presidents have argued. It's sort of odd that U.S. Congress has to pass spending and revenue bills, and then it has to make a separate decision about whether that's going to be funded. That doesn't strike me as right. I think once you make the decisions and you approve spending and revenue, then you also have to accept, without a separate decision, the consequences that's going to have for debt. I mean, as far as I know, there is no other country that goes through that process. Yes, we have, you know, for instance, Germany has a so-called debt brake, which is constitutionally insured. There are other countries, Indonesia, which have limits on public sector debt, on public sector deficits, excuse me. But this separation of agreeing on what deficits do and what debt does doesn't strike me as very sensible.
Do you think that when it comes to kind of the conversation in the economic sphere specifically in this next year, perhaps economists, and strategists alike may lean more towards Kevin McCarthy's kind of argument that austerity is the only way forward, perhaps using the roadmap that the likes of Germany, for example, has to offer when it comes to the budget?
Well, you know, Germany, I mean, these things don't tend to work. You shouldn't, I mean, it's very difficult to run fiscal policy, I think, on rules. Because fiscal policy has, in my view, a really, really important and central role in stabilizing economies. And you don't know what kind of shocks are going to come. So I'd be very careful about making strict rules which might really hinder your ability to manage the economy.
Can I go back to this idea of private sector debt? What are you expecting the default cycle to look like?
Well, I mean, economic growth is probably going to slow and continue to be relatively slow. It's going to happen quite late. You see, there's something really interesting that my colleagues were hotly discussing, which is the net interest burden on corporates in the U.S. in particular has actually gone down. Because, and what's probably behind, and this is very atypical, of course, because interest rates have gone up, so what's going on here? And, you know, in a way, a lot of companies have turned themselves into something like banks. When interest rates were very, very low, they issued a lot of debt at longer-term tenors, even though they didn't necessarily need that money, and so they put it in the bank. And now they're still paying super low interest rates on those bonds, and they're getting lots and lots of money from their deposits. But of course, that's not going to last forever because those bonds are going to mature. I mean, they were, of course, issued at different tenors, longer than usual, 5-7 years. But that's not going to last forever. So while there might be a delayed reaction, you know, the fact is that, one, labor costs are still rising quickly. Unit labor costs are rising quickly. Whether the pricing power that companies have enjoyed is going to last forever is an open question, but I don't think it would be outrageous to assume that it's probably going to fade a little bit. And then in the background, you have higher interest rates. So I think it's going to be very difficult. So the default cycle, you know, don't ask, you should ask my colleagues from the credit strategy about the exact default cycle. But yeah, they think that default rates are going to increase sharply.
Don't sell yourself short. That was an excellent answer. That was fantastic.
Klaus Baader, we have to leave it there. I'm so sorry, so much to digest with you. SocGen's Klaus Baader joining the program this morning about the ramifications that we are seeing of this Fitch downgrade. Coming up, though, we go to the micro. Another chip maker beating the street. AMD shares gaining after topping those second quarter estimates. More on that and a drumbeat to Qualcomm's results next. This is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. AMD, Advanced Micro Devices, edging higher in the pre-market. The chipmaker topping second quarter estimates. Bloomberg Tech reporter Aggie Cantrell joins us now to walk us through it. Aggie, the shares higher by about 0.8%. AMD seeing quite a bit of a turnaround this quarter. Is it all AI?
Yes, it really is. That is the focus of the turnaround for sure. Essentially, AMD is developing AI accelerator chips, which are crucial in order for companies to tool out their data centers and to speed up AI development. That is a critical part of it, and they are seeing that they are gaining interest in the same way that NVIDIA has done. Not to the same extent, but they definitely are. And this is a part of this broader adage that keeps being heard in this area right now, that there are chips and then there are chips. And a company like AMD is really benefiting right now for having invested in these accelerators that are so crucial for data centers.
We're also going to get Qualcomm reporting results, Aggie, the company that makes semiconductors for phones. What are we looking out for? What's in focus for their earnings?
Yes, so Qualcomm has a huge amount of its focus on the smartphone market. And that is a critical part of this because the smartphone market is essentially, there is a question around the amount of demand, consumer demand, that is still on the smartphone market. It does seem like it is recovering somewhat, especially when you look at certain areas of the economy. There is a risk around China's appetite for smartphones right now. But really, this is a twofold thing. One thing is regaining consumer demand, and the other thing is that when these companies, the companies that buy Qualcomm chips, whether they've done with had enough, they've reduced their stockpiles enough to start ordering at a greater pace, and that's a critical issue for Qualcomm. And so we're going to be looking out for that too. Have people started ordering again at a pace, and are consumers returning to buy more smartphones?
Well, Aggie, let's just stick with that chipmaker story as well, because we know that some of their competitors, Intel, for example, NVIDIA, are also going to be potential anchors for the ARM IPO coming out of SoftBank as soon as next month. We're getting some news when it comes to the valuation of that. Walk us through those numbers.
Yes, so essentially the crucial thing about this that I found interesting is that they want this as soon as September. Essentially, SoftBank is looking to cash in on this bullish attitude towards chip developers, especially these chip makers that are making these high-end AI chips. That is really where this is. They're pushing for this early IPO, potentially as early as next month, because they really want to be able to capitalize on that. And when you look at ARM, you're also seeing a shift in that valuation from the public markets. We've seen the NVIDIA boom a month or so ago, and now we're seeing that this valuation is potentially between $60 and $70 billion. Earlier this year, bankers were rating this at around $30 billion at its lowest level. And so we're seeing that this IPO could be a real boon for SoftBank at a time when they really need it.
Yeah, $60 billion, massive. Aggie Cantrell walking us through all the stories we need to know in the semiconductor space. We thank you, as always. We go from big tech to big coffee, I suppose. Starbucks quarterly sales fell short of analyst estimates. Joining us now, Bloomberg Simone Foxman, all over it. Simone, the results flagged weakness among North American consumers. Is this just the people like me who are saying $7 for a caramel latte, you just can't do it?
Well, a lot of Starbucks' success recently has been built on the back of price increases. And so what these numbers are suggesting, the important 7% increase in comparable sales on a year-on-year basis, coming in lighter than expected. The anticipation in the United States was for 7.7%. But yeah, essentially, there are customers still looking to customize their orders, but they're also, these customers have faced a lot of price hikes, especially continuing to face lots of price hikes at restaurants. And Valerie Titel put together a really interesting chart for us, just showing that the cost of eating out food outside the home, and this coming from CPI data, is really continuing to rise, whereas we've seen costs of groceries stabilize. So yes, when you order a $7 drink, there is just a limit to how much of these prices increases that a North American consumer can apparently tolerate, and that's what Starbucks is seeing.
I mean, it's kind of the adage, right, when you're talking about personal finances, stop going to Starbucks, make coffee at home. So you'd assume Starbucks is the first they ditch. Overall results, away from just even the U.S. consumer, what else stood out?
Yeah, I mean, admittedly not necessarily ditching the venti latte, but certainly not wanting to buy more of them. I think other things that stood out, really China is very important when we look at the Starbucks story. We saw the comp sales numbers there rising 46% on a year-on-year basis. That's, you know, a little bit hotter maybe than some analyst estimates, roughly in line with most of them, but I think the concern there really the outlook. You know, Starbucks executives on the call yesterday pointing out that there isn't as much penetration in the Chinese market as there is in somewhere like the United States. But there is concern that, you know, if you only see comp sales return to normal at like a high single, maybe mid-single digit pace, that's going to be a little bit of a problem. Also, one thing that we're really watching is how much money the company is spending on wages. They've had some tangles with their union, so that's an important one as well.
Certainly something we're going to be keeping our eye on. Those shares already down by about 2% this morning. Simone Foxman walking us through all of those earnings stories. Coming up more on the fallout, Fitch's U.S. downgrade. Stick with us. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is clearly negative press, quote unquote, for the U.S. at a fairly fragile time internationally, as you point out. On the other hand, there's no obvious replacement for the U.S. as the dollar currency.
Berenberg Capital Markets senior economist Mickey Levy there, weighing in on the Fitch's U.S. downgrade. Joining us now for a little bit more context, Bloomberg International Economics and Policy Correspondent Michael McKee. Even I'm old enough to remember the last downgrade for the U.S. credit rating. And look, this is pretty normal that a lot of the members of Congress and some of the economic officials are saying, look, this is unjustified. Is it unjustified?
Yeah, you could argue it is, because the U.S. has its own printing press. It's a sovereign country. It can deal with its debts. They've never failed to pay, despite the drama that we've seen. Still, Fitch does have a point when they talk about the future trajectory for the U.S. The repeated debt limit political standoffs and last-minute resolutions, they say, have eroded confidence in fiscal management. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. Now, that's a justifiable reason for being concerned about the path of deficits. The question is, does it matter to anybody? Not really. The cognoscenti are weighing in, and Fitch is getting very negative reviews. Same sort of thing that happened back in 2011 to S&P. Janet Yellen, of course, calling it arbitrary and based on outdated data. Former Treasury Secretary Larry Summers calling Fitch bizarre and inept. And Jason Furman, the former chairman of the Council of Economic Advisors, saying it's very hard to understand.
Well, I mean, we're looking there at some of the criticisms, Mike, and I think a lot of it seems to be around the timing of this. When S&P did it in 2011, it was just days after the crisis, over the debt ceiling after that had been resolved. We're months afterwards here.
Yeah, it doesn't make a lot of sense. I tend to agree with Jason Furman that maybe this might have put a little pressure on Republicans and Democrats during the debt ceiling fight, but now that it's over, that's suspended for 2 years. We won't revisit that till 2025. So kind of what's the point? When you look at what happened after 2011, and as you point out, that came out just a day or two after the debt ceiling was solved, well, we had a brief reaction in all markets, and then you can see stocks went up, the dollar went up, and bond yields went down. So this kind of fits that old Shakespearean line about sound and fury signifying nothing.
But it feels like there may even be, just to play devil's advocate here, a point to what Fitch is saying, in that if you are looking to this next debt ceiling standoff in, I think, January 1st, 2025, which comes right off the heels of a presidential election and coincides with the lame duck session in Congress, how are you supposed to fix the next debt problem if you're not even entertaining the idea of the austerity measures that Kevin McCarthy had put forward? Well,
here's the problem with Fitch, and that is that this is going to be forgotten by then. Nobody on Capitol Hill remembers S&P downgrading them, and clearly when you look at what happened to the markets after that, there was no impact. So if the idea of defaulting on U.S. debt doesn't move people to do something, Fitch piling on isn't going to move people to do anything either. And it's going to be very interesting. A lot of this is going to revolve around the Trump tax cuts, which expire for individuals in 2025. Then you could see some additional pressure from the ratings agencies if they're renewed and nothing is done to offset them. But that's a problem for another day. And as we all know, Washington loves nothing more than to kick the can down the road.
A lot of deadlines in the Washington planner. Bloomberg's Michael McKee walking us through all of it. But it's that exact point that Mike was just making when it comes to the bond market, because take a look, it's not doing much. And the S&P 500, the S&P downgrade story back in 2011, you saw this massive bid into the front end of the curve, Danny. You are not seeing that this time. The 10-year yield at 402, literally unchanged when it comes to that. Meanwhile, the equity market taking the brunt of the hit.
Yeah, a lot is different this time than in 2011. We also can't forget that in 2011, there was also the European sovereign debt crisis that pushed us into U.S. sovereign debt. And at the same time, the worry for the bond market, the reason it got punished yesterday seems to be the Treasury saying that it would have to borrow about $1 trillion for that widening deficit. That supply seems to be a bigger story. All right, that's it for Critty and me for early edition surveillance.
York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I sympathize with the analysts at Fitch and take my hats off to them for doing this when it's not a moment of brinksmanship.
Clearly, it's not good news, but if we look at the initial market reaction, pretty moderate reaction in the bond market.
No country that has the strength of the U.S. is going to be affected.
The main question is, does this compromise the reserve currency status of the U.S. dollar?
I have learned very painfully that one never wants to forecast the demise of the dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From AAA to AA, live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. More than a decade since the last one, it was S&P Global Ratings ditching the top rating for the United States of America. Fitch follows up after the close yesterday with this quote right here. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA and AAA rated peers. Lisa, this morning, whether it's justified and if it matters are two different questions.
I would agree, especially as this is the second major rating company to downgrade the United States from the AAA rating. The response, arbitrary and based on outdated data. That's Janet Yellen. Larry Summers, the idea that this is actually an increased default risk is absurd. I don't think Fitch has any new and useful insights into the situation. But here's the question. Is there something real behind this in terms of how much interest rate expenses are going up and how much lack of conviction there is on Capitol Hill?
We'll go through the 3 points. We'll pick out one of them, governance issues. They're pretty obvious, aren't they? There's clearly governance issues that the United States has that is inconsistent with other AAA-rated peers like, say, Germany.
I would agree with that, especially because we were talking about the possibility of the U.S. defaulting on their debt, even though it wasn't a fiscal issue. It wasn't an ability to pay. It was a desire to pay. And this really does raise some serious questions. Just to put this into perspective, Fitch first raised this issue back in May. It stuck to its guns even as the U.S. government worked through the debt ceiling. This really highlights the ongoing concern that this will be an issue every year going forward.
Equities right now negative about 0.75% on the S&P 500. In the bond market, yields are just about unchanged, a little north of 4% at 4.02%. Lisa, the market fallout. Can we call this fallout on the screen this morning? What do you make of that?
To be completely honest, I was reading notes saying that this had to do with the Fitch downgrade, and I said I don't buy it. I think this probably is, I read one person comment that this is an excuse to sell and to capitalize on some of the gains, especially in light of some of the weakening data out of China, out of the weakening data in certain sectors across the world. I buy that more than I do this because the move has been always the same. Go into treasuries, the exact opposite of what you would expect if there was an increased default risk.
You mentioned the pushback that came from the administration. This was the pushback that came from Secretary Yellen. Fitch's decision does not change what Americans, investors, and people all around the world already know, that Treasury securities remain the world's preeminent safe and liquid asset, and that the American economy is fundamentally strong. Joining us now is Bloomberg's Anne-Marie, our chief Washington correspondent out of Washington, D.C. AMH, how did this one go down?
Well, this one is going down differently depending on who you ask, of course, Jonathan. The Republicans are going to point to Bidenomics and saying that this president and the legislative agenda he's been on has just added more money to the market and has increased inflation. And it was on Bidenomics that now you have this downgrade. And then, of course, Democrats are going to show the brinkmanship and the chaos, frankly, that sometimes happens on Capitol Hill. And that is something interesting about this Fitch downgrade. It comes after they were able to come to a consensus on raising the debt ceiling. But obviously what Fitch is looking at in Washington is that there's not a lot of consensus about appropriations. And potentially in the next few months, we could see a government shutdown. And what Fitch seems to be evoking here is what a lot of journalists and Americans see all the time, is that there's these constant 11-hour deals that are being done in Washington, and it's just not important for the fiscal health of the United States.
They referenced that directly in the lead quote from Fitch yesterday. The governance issues relative to AA and AAA rated peers over the last 2 decades has manifested in repeated debt limit standoffs and last-minute resolutions. Anne-Marie, is there any reason to believe those last-minute standoffs end anytime soon?
Absolutely not. I would certainly not hold your breath on this one. This happens time and time again. Remember when S&P downgraded the United States in 2011, they actually also did reach an agreement on the debt ceiling, yet they were still downgraded. It's because this brinkmanship is the concern, even though Fitch did point to what the Treasury Secretary Janet Yellen is trying to get across to the American people, is that the U.S. at this moment has great momentum and economic health. But it does seem that Fitch is incredibly concerned with this brinkmanship in Washington, which honestly, going into an election year, is just going to get much worse.
So all of the comments that I've read have basically been saying this doesn't matter. It doesn't matter to markets. It doesn't matter to politics. It doesn't matter to a lot of people who are just shrugging off Fitch and saying, why are you doing this? On the other hand, the U.S. interest rate payments have basically increased by about 50% over the past year to nearly $1 trillion a year. You're looking at the likelihood of increased default risk just based on this brinkmanship alone. Is there anyone in Washington, D.C., who does care, who does not necessarily agree with Janet Yellen and thinks that this is a big deal?
Well, the Republicans certainly do, and I'm sure we're going to hear from a lot more of them as the weeks go on. The issue they have politically with this downgrade, yes, a lot of people are shrugging it off. The Treasury Secretary is calling it arbitrary. Others seem to be puzzled, like Mohamed El-Arian, because the timing and why this is happening when the data looks good. The fact of the matter is, now this president, the Biden administration, will own a downgrade on their watch. So this headline will now be used in every campaign ad, depending on who he is up against in 2024. And we know that time and time again, the economy consistently ranks top of Americans' mind when they head to the polling box.
AMH down in Washington. Anne-Marie, we'll catch up with you in the next hour. There's a lot to talk about over in Washington, D.C. at the moment. We talked about the governance issues being totally inconsistent with peers who are rated AAA by the likes of Fitch and others. Also the debt burden, totally inconsistent with peers elsewhere as well. The U.S. debt burden is set to reach around about 120% of GDP by 2025. If you take the median right now of others in the AAA bucket, the median's 39%. Lisa, it's night and day. Just the difference is totally night and day.
Especially at a time of raising interest rates. I mean, that's the key, is that the rapid pace that the financing expenses are increasing is going to raise some eyeballs, especially today when we get some sort of refinancing plan from the Treasury Department. They release just how much they're going to be borrowing, and we can extrapolate out what the likely expense is. That said, what do people do? They buy treasuries.
Exactly.
That is the haven trade. And you have resilience and you have robust growth that is outpacing some of the other nations that have much smaller debt loads.
That's why we have this visceral reaction to this stuff. There is this belief that the American economy, the US debt market, has this special place in our market universe. It is the sun. And everyone else is just the planets that orbit that sun. And for that reason, this should always be AAA. You can't replace treasuries with anything else. There is nothing else out there. And for a lot of people, the US is never going to default. So why wouldn't it be anything other than AAA? That's why you get that emotional response by a lot of people in markets.
And a lot of people who are fund managers came out overnight and they basically said, are we actually going to adjust anything in our portfolio because of this? Nope, not a chance. And frankly, the rating agencies haven't exactly bolstered their credibility over the past, 20 years.
Terry Haynes joins us now, founder of Pangea Policy. Terry, we've seen one of these before, a little more than a decade ago. Terry, you witnessed that as well. We all did. Can you tell me, first of all, whether it's justified, and then we can get into whether it matters?
Well, look, I think a lot of the issues that both you and Lisa have brought up are entirely valid about interest payments and all the rest. So let me just start there. Secondly, politically, I think it is bad news for Biden, as Anne Marie has talked about. Thirdly, I questioned Fitch across the board, and particularly the timing. Fitch is older than the debt ceiling law. They were founded 3 years before the first debt ceiling law happened. And, now they're bestirring themselves to complain about the process through which the United States appropriates money and deals with its debt. So, whatever else is going on here, I think there's a motivation that's a little less pure than a lot of people would want to talk about. And finally, the economists, a lot of the same people that are complaining about Fitch are the same people that were entirely silent through the whole money printing and fiscal bloat era, and I think they're a little bit more concerned that might be ending for good. So I think overall this isn't going to be worth very much.
That said, there is a real concern over just how much the budget is ballooning in terms of debt versus GDP, how much interest rate expenses are going up. I mean, to me, the idea that it went from about $600 billion to nearly $1 trillion in a year is pretty shocking, given the fact that interest rates have been going up. Terry, from your perspective, when you take a look at some of the plans, the economic plans that are coming out of the Republicans and the Democrats, is anyone seriously talking about remedying this or bringing in costs that could potentially cut benefits?
No, they haven't talked about it, and they won't talk. They haven't talked about it for decades, and they won't talk about it. The good news and the concerning news every year when spending is fixed is really the same thing. Firstly, on-book spending tends to be more or less status quo with some minor adjustments. But the off-book obligations, whether it's student loan debt or housing or anything else, are humongous, and that's never dealt with in any sort of way, and it's not going to be. There's no percentage for any of these politicians to want to take it on. There's no percentage for the White House to want to address it forthrightly and explain to the public why it's a bad thing, why it amounts to a tax on them, and so on and so forth. So that situation won't change. That's properly identified. I question kind of the timing and the why.
You said that this would be politically damaging to President Biden heading into the 2024 election, and this comes at a time of an indictment of former President Trump. And I'm wondering, a lot of people thinking that a runoff between Trump and Biden, a sort of repeat of what we saw in 2020, would necessarily end up with Biden winning. Are you starting to question that?
Oh, I've never thought Biden was a shoo-in or anything of the kind, and I still don't today. You can go back a few months and see that, and I think I did this on your air once, where about 2 or 3 months ago, where you could look at different national polling and see that Trump was either beating Biden or was running essentially neck and neck with him. That's still true. Kind of what the indictments for me mean is that markets have a lot less certainty about what the outcome is going to be. So I think there's going to be a lot more trepidation, and this kind of motors on for a while as a silent market negative.
Terry, there's a sense that we've lost sight of how serious some of these illegal issues actually are. A sense of fatigue, I think, for a lot of people in this country. Terry, just to go through some of the federal charges: conspiracy to defraud the United States, conspiracy to obstruct an official proceeding, obstruction of an attempt to obstruct an official proceeding. Again and again and again, these things come up, Terry, and people in this country, many of them, shrugging their shoulders towards that. Terry, just how serious are some of these charges?
Oh, I think the charges are quite serious. I think their provability is very difficult, and I'll get to that in a second. But let me just say off the top, you know, you've got the world those people are living in now, or the world where you know, Trump is indicted. As my daughter says, it's a day that ends in Y. So isn't there another Trump indictment? Firstly, secondly, you've got a splurge in the Biden matter, where we've now moved into a situation where Biden seems to have been involved in his son's business, which is directly contradictory to what he's been saying for years. That's going to be a problem. We're just at the beginning of that. And thirdly, you've got a situation, you know, with this prosecution itself, where the indictment concedes that Trump has a right, like every American, I'm quoting, to speak publicly about the election and even to claim falsely that there had been outcome determinative fraud. But now we're going to start prosecuting based on what he did about that. The prosecutor's going to have to establish motivation, and it almost seems to me like a few good men kind of code red examination, cross-examination. You're going to have to get the state of mind at a time where you know that the White House had different advisors telling the president different things. How do you get to the bottom of that? Very difficult.
Terry, what a 24 hours in Washington, D.C. Terry Haynes of Pangea. Terry, thank you. Equities down here by 0.7%. Bob Michael at JP Morgan coming up a little bit later. Live from New York City. Good morning.
source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, trying to open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. The Fed is hoping for slowing job growth, but too much could spell trouble.
There is no way that many people would have predicted the kind of data that we witnessed.
Things have slowed down, but they're not falling off a cliff.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
Which nominal wage growth does the Fed need to see?
At what point do people start to say, this is not sustainable?
Maybe this will be the turning point.
The July Jobs Report, Friday on Bloomberg Television and Radio.
This is a little bit surprising, probably more in the timing than the actual downgrade. I think this will be used as a political cudgel against the Democrats and particularly against the president going into this election cycle. Absolutely. I mean, we are already seeing kind of the politics of austerity, if you will, kind of creep back into the kind of the zeitgeist. But again, does this all really matter in the kind of the market landscape? You know, probably not so much.
There is a feeling this morning that the political fallout will be larger than the market fallout. That was Libby Cantrell, PIMCO's head of US public policy. Just as the headline dropped across the Bloomberg terminal yesterday afternoon after the close, the United States stripped of its AAA rating, this time by Fitch, more than a decade after S&P Global Ratings. Here's the market fallout. I have to say it's pretty muted stuff relative to the gains that we've had in this market year to date. We're down by 0.7% on S&P 500 futures. The bond market, would you have a clue that anything has happened based on this move this morning? The 10-year, 4.02%. The move was yesterday, Lisa, at the long end of the curve, as we started to get a sense of just how large the deficit and the refunding and the bond issuance that we're going to get from Treasury might have to be this quarter.
And that, to me, is the real story. And the Fitch noise is going to be a political cudgel, as we heard from Libby Cantrell. But we're looking at a real situation where the U.S. has to refinance trillions of dollars of debt at a time where its interest rate expenses are surging. At what point does this become a real problem for Congress and, frankly, for presidential candidates that are not proposing to cut Social Security or other things that would be just basically dead in the water types of political views?
If you missed it, here are the numbers. So this came just before the downgrade. The Treasury Department set to increase its net borrowing estimate for the July through September quarter, so this quarter, to $1 trillion. That's up from $733 billion that it had predicted back in early May, and is much, much larger than a lot of people thought as well. And Lisa, we're going to find out a little bit later, right, just where on the curve some of that issuance is going to land.
8:30 a.m. we get that announcement, and we're going to work through it with Michael McKee. How much will that push up long end yields, which moved to the highest levels in years? I mean, this to me is really important to focus on, given the fact that everyone's talking about interest rate expenses coming back down, inflation coming back in, normalization. What does normal look like in a very different interest rate expense environment, and one where this government keeps borrowing more and more money?
We've got a fantastic lineup of guests to dig through some of the political fallout and the market fallout as well. Let's get to Chris Verrone, partner and head of technical macro strategy at Strategas, a Baird company. Chris joins us around the table in New York. Chris, good morning.
Great to be here.
Lots going on. Not a quiet summer, that's for sure. Not a quiet start to August. We've talked about whether it's justified. Let's talk about the market fallout. Does it matter?
You know, I was thinking about this last night, the differences between this downgrade yesterday and it was actually, I think, August 5th of 2011 was the downgrade. The yield setup was actually very different. Yields were falling into the 2011 downgrade. Yields were in a downtrend. We kind of have a saying, surprises always break in the direction of the trend. And the trend in yield is up right now. I understand the reaction the last 12 hours is relatively muted, but you've had a ripper in rates over the last couple of weeks here, and I love a good paradox, and I think the market likes one as well. And you go back to the 3% CPI print on July 12th, you know, yields traded all the way down to 370. They've made up that whole move back. They were 395 before the CPI. They're 402 this morning. 30-year yields have really moved here also. So I think the surprise here ultimately will still be yields up in the direction of the trend.
The market backdrop, the economic backdrop back in 2011, I remember the conversations we were having back in London at the time. We had the Eurozone debt crisis on our doorstep. It was just totally different. But there was a conversation. I remember Bill Blaine being on the phone with me at the time. I think he was with New Edge going years and years back. And he said, John, if they get downgraded from AAA to AA, it won't be treasuries that people sell. It will be other stuff to make space for treasuries. Is that dynamic kind of in play this morning?
You know, I remember getting the 2011 call wrong. I was in the camp that a downgrade would mean higher yields back then. And I want to make sure this time around the recency bias of that experience doesn't change how I interpret this. So I really do think this time around it does mean yields up here. I would also emphasize, remember, that led to an easier central bank or an easy monetary policy response. You had Jackson Hole that soon followed in August of 11. You got, I think, QE2 or QE3 that came out of that. I don't think that's going to be the monetary policy response from this. And, you know, you speak of all the things since that 3% CPI print a couple weeks ago. I mean, commodities have ripped here as well, right? So you have commodities up and you have rates up. And I think generally you have complacency around the equity market here after a very strong start to the year. I just would want to watch my back.
Can you imagine if at Jackson Hole, Jay Powell comes out and he's like, I would like to talk about the Fitch downgrade to the United States somehow.
It's just a different time.
Yes, I would agree. It's a different time with different qualifications. That said, I am wondering whether you do expect going forward, and we were talking about some of the political risk, and we were just talking with Terry Haynes, who said he does expect this to start getting priced in a little bit more with a move away from certain U.S. assets, given some of the uncertainty around the political backdrop. Do you buy that argument? Is that one of the reasons why you see yields going higher?
I think at the end of the day, it's still a question of where you go. What's the alternative? Dollar response has been fairly muted here over the last 12 hours or so as well. I do think it's interesting. Gold did rally. Bitcoin has rallied here a little bit as well. So maybe there's some alternatives there. But if there's another difference maybe from the 2011 experience versus today, and you look at the Chinese and you look at the Japanese, they're big net sellers of treasuries here. And they've been big net sellers of treasuries for the last year. That was not the case kind of in that 2010, 2011 period. So there's a lot of different dynamics where I'm almost hesitant to compare this incident with the 2011 incident. I think they're very different. I think the outcome will ultimately be different as well.
You were talking about yields ripping, and we've been talking for the past couple of months how it seems like risk assets are not noticing. They don't seem to care this time. Is this a sort of reset moment? Not just because of Fitch, not because of the political backdrop and legal cases, but because people are kind of getting a little uncomfortable whether this yield space is going to create something more significant.
You know, I was thinking about this a few weeks ago. When you look at how strong the first half of the year was, it's really only rivaled by a couple other years in history. 95, the first half of the year was very, very strong. 98, and actually 87. And when you look at 95 and 98, the strength continued in the second half because bond yields kept falling. So equities rose, bond yields kept falling. 87, we know, is the opposite, right? Bond yields rip in the summer of 87. And you get this very uncomfortable setup where yields are up and equities are up, and we know what happens then in the fall of 87. I'm not saying that's what's happening here, but I do find it curious when you get yields up big and stocks up big, something tends to become unsettled very quickly.
Is that technical, though? Highly technical, or is it somehow linked to fundamentals? Is some kind of better outlook on the cycle, some cyclical impulse kicking in? Which one is it?
Yeah, it's a great question, John. And, you know, here's how I kind of try to answer that or put those puzzle pieces together. When rates are rising and cyclicality is still outperforming, I think it's a message that the market's comfortable that the message in yields means economic activity is still relatively robust. When I see defensives outperforming, even as yields go up, that's a different message. That's the message, whoa, wait a second. Yields are telling us something's about to change here. Fortunately, we don't have that yet. I mean, cyclicality is largely still leadership here. You see it with semis, you see it with transports, but that's what I want to be on guard for here, because yields up with defensives working is not a very compatible combination.
It's a kind of strange moment that we're seeing this commodity story, this bond market story, with China clearly struggling to find some growth. How do you reconcile those two things?
Yeah, it's you tell me. I don't know. We're trying to put these pieces of the puzzle together, and we put out a list last week. It was 13 signs commodities are reinflecting, and everything from oil back above the 200-day for the first time in a year. I mean, the breakout in the copper stocks has been compelling. The breakout in the steel stocks has been compelling. And again, it's a kind of this paradox that it's all happened basically since the 3% CPI print in early July, also coincident with Janet Yellen's trip to China. So you kind of wonder what deal may be brokered, right?
Deep into the conspiracy.
Seriously, I was about to say.
I mean, you look at the response from the commodities here. They're acting like the Chinese are going to put their foot on the pedal. I thought copper, you know, back up to this 390 neighborhood's important, and I thought the move in crude is a change.
Okay. I think this is a conversation for commercial break. Chris, thank you.
Thank you.
Chris Veronis. Chris, it's good to see you. Equities right now down about 0.75% on the S&P 500. Later on this morning, we'll get an ADP jobs report, pushing ahead to payrolls on Friday, and plenty more on this downgrade from Fitch on the US credit rating. John Reidig, the Chief Economic Advisor at Breen Capital, coming up.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute, and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What a morning. What a 12 hours. Equities right now on the S&P negative by 0.7% on the S&P 500. Following that downgrade, we're negative by 1% on the NASDAQ. Tomorrow after the close, a big day for the NASDAQ 100. Apple and Amazon just around the corner. In a bond market, first place I looked after that downgrade, yields totally unchanged on a 10-year, 4.02%. There was this shift higher in longer dated yields. We can talk about the Treasury refunding still to come. The 30-year right now at 4.1%. The 2-year yield's just a little bit lower here. We're down by 3 or 4 basis points. I don't think you can make too much of that. 486.21 going into the ADP jobs report a little bit later on this morning. That comes at 8:15 Eastern time, so 1 hour and 45 minutes. To finish in foreign exchange, bit of yen strength out there, maybe sort of speaking to that risk-off move. Some euro weakness, just a touch. We're negative by 0.1%. Euro dollar at 109.73. Under surveillance this morning, then, Fitch Ratings stripping the US of its top-tier sovereign credit rating, cutting it from AAA to AA+, and a statement writing this. Fitch saying the rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance. I think this is the issue here, Lisa, this line here. The erosion of governance relative to AA and AAA rated peers over the last 2 decades. It's hard to argue against that last line.
We were just worrying about whether the U.S. would default on its debts just a couple of months ago, and it was a really real risk simply because of political gridlock down in Washington, D.C. We don't get that from other countries. That said, even at that time, what would the response be to a default? Probably buy more treasuries, because it was just viewed as political gridlock, exactly what it was. So there's a sort of odd dissonance right now to markets being like, guys, just quit it. We all know that treasuries are fine and the economy is good. And then you've got the political reputation where there is some sort of risk and feeling of instability that Fitch is reflecting.
You mentioned a pushback from the administration, Secretary Yellen calling the move both arbitrary and outdated. Some high-profile economists piling on Fitch as well. Mohammed El-Erian, a good friend of this program, good friend of ours, writing this. The vast majority of economists and market analysts looking at this are likely to be equally perplexed by the reasons cited and the timing. Overall, this announcement is much more likely to be dismissed than have a lasting disruptive impact on the U.S. economy and on markets too. Larry Summers, you mentioned this line a little bit earlier, Lisa. The idea that this is creating the risk of a default on the U.S. Treasury market is absurd, and I don't think that Fitch has any new and useful insights into the situation.
It's telling that you talk about this, we talk about this right after you mentioned euro weakness versus the dollar. The response in markets emphasizes, underscores what we're hearing from Larry Summers, from Mohammed El-Erian, from Janet Yellen, which is we don't care. And if anything, in a moment of instability, we will go into U.S. assets. That said, longer term, and we have heard this from a lot of people questioning the dollar's dominance, and a lot of people have gotten that wrong many times again and again. But there is a question of longer term consequences of just the debt borrowing, what we're going to get at 8:30, that I think are real and are going to be really important issues for the
These
future.
Conversations are precisely the same ones we had more than 10 years ago.
Yes.
And if you draw a line in the sand, I think it was August 5th, back in August 2011, take the dollar index, have a look at what it's done since then to now, it's up something like 40%. 40%, and we had exactly the same conversations more than a decade ago. The growth profile right now, of course, and this is just an observation about the past and where we are, it's not about where I think we're going, but the growth conversation now is so much better to the growth conversation we had back then. Mike Apen of Bank of America capturing that, and I just wanted to bring you this quote. The head of US economics over at Bank of America saying this: recent incoming data has made us reassess our prior view that a mild recession in 24 is the most likely outcome. Growth in economic activity over the past 3 quarters has averaged 2.3%. The unemployment rate has remained near all-time lows, and wage and price pressures are moving in the right direction, albeit gradually. They're dropping their recession call, Lisa.
Who isn't dropping the recession call? I saw this, and it's just pretty much one after another, dropping recession call, upgrading expectations for risk assets and what they're going to return. At a time when more people are leaning into the soft landing kind of narrative, I do wonder whether people are feeling like maybe they've gotten over their skis. A couple of recent hints on the consumer spending side, a couple of recent earnings reports raising some issues on that. I think about Starbucks, for example. I'm not saying that, Frappuccino is going to really make or break the U.S. economy, but my point is you are seeing some pushback on the margins in a couple of different sectors, and you do wonder whether it does actually mean that there is weakness.
It's odd yesterday, just going through the earnings, and this is always my issue with earnings sometimes. You can pick a company and tell whatever story you like.
Yes.
Starbucks is one. Let's take JetBlue. So JetBlue's telling us the domestic economy isn't as good as you think, and Caterpillar's telling us the international economy is not as bad as you think. Can you make sense of that from those two names?
Well, but this is actually the most interesting part, because this is what a lot of people have been calling a manufacturing resurgence, which Caterpillar perhaps points to, and the rally that we've seen in oil prices points to. At the same time, the consumers get more discretionary. Maybe they don't want a Frappuccino, but maybe they want to go and stay in a hotel, a luxury hotel, and swim in the pool. I mean, these are the kinds of things. It's not like anyone's crying for them, but my point is you're seeing some real gangbusters kinds of earnings from the hotels, from other airlines that are international.
Yeah.
Are people just kind of shifting their money slowly in a way that's going to have significant ramifications? It's a confusing market. When you look at the earnings, it doesn't really help.
TK is poolside this morning, I'm told. He may or may not join us tomorrow.
Without a Frappuccino.
Going into payrolls, without a Frappuccino, of course, something much stronger than that. I've talked a lot about our lineup this morning. On the bond market, you'll hear from Robert Tibb of PGIM, Bob Michael of JP Morgan Asset Management through the next couple of hours. On the politics, the political fallout down in Washington, D.C., Henrietta Trays of Vader Partners will be joining us in about 25 minutes. Joining us now is a man who's seen it all. John Reining, Chief Economic Advisor at Bring Capital and a former Economic Advisor to the Bank of England. John, good morning to you.
Good morning.
What did you make of that one yesterday afternoon?
What are we talking about here?
The downgrade, not the indictment.
It seems 12 years out of sync. I agree with the comments of both Summers and El-Arian. I mean, there's no particular news to spur. We know the fiscal trends in the U.S. Have been bad and will continue to be bad, as signaled by the outlook from the CBO. So we got through a terrible political battle over the debt ceiling, and somehow we got through that. So. But in the end, it's the U.S. Treasury, and I don't think people buy U.S. Treasuries because of a rating of some rating issues. There may be technical issues for some people, what they can and what they can't own in certain structures, but I think it's just it's a bit of a head scratcher while recognizing all the bad things that they're saying, including the questions about the breakdown in governance.
It reignites the same conversations. We all understand how privileged the U.S. Treasury market is and how privileged the U.S. government is to issue that debt. The question still remains, are we abusing that privilege? Would you agree that we are?
Well, I think the U.S. has abused the privilege, and I think they abused the privilege, the more important one, the privilege of seigniorage of the print of the currency. And so much of the currency is held internationally, and in an era of digital assets and so on, it's amazing how rapidly the growth of paper money has expanded, and most of that is created up and shipped out of the U.S. and circulates overseas. But in terms of that, and Lisa just made reference to it, but there really is no viable alternative for a long time for the U.S. dollar in terms of its role in international finances. So again, a change in a rating by a debt agency isn't going to change very much.
Sure, and we can question the relevance of Fitch and question the political implications of it, as Terry Haynes was raising some questions around how pure the motives were of this rating agency. However, there are some real issues going on, and they'll be highlighted in about 2 hours' time when we get the refinancing agreement, or we get the refinancing plan by the U.S. Treasury, expected to be more than $200 billion more for this quarter than people previously thought, at a time when interest expenses are surging. Does that not matter?
Oh, I think it does matter. You know, the U.S., in terms of its responses during the COVID period, what it did in March of 2020 was absolutely needed. But the fiscal actions that were taken in late 2021, when we and Larry Summers and others were doing calculations to say, hey, this is just too big a fiscal stimulus for the U.S. economy. And long-term issues. I think you made mention. I think I heard you saying about not cutting Social Security. I mean, that's the that's the third rail. That's never going to be touched, especially in an era where demographics are getting older. So voters are getting more entrenched in terms of receiving Social Security. The opportunity to reform that change disappeared in the early 2000s when the Bush administration considered creating private ownership, as the president told me, not privatization, private ownership of Social Security, and that died a death. So those terrible fiscal trends are going to remain in place.
As an economist, though, there is a question of at what point do interest rates become unsustainably high based on the debt load that we have. And I ask this because of the response of 30-year treasuries yesterday to the debt issuance, not to the Fitch rating cut. And I'm wondering at what point, at what profile, does this become a real negative concern for the creditworthiness of the United States?
Well, let's take some rough numbers. We've got a debt-to-GDP ratio right now of around 100%. And we've got a 10-year treasury of 4%. So if we assume that 4% was the number in terms of interest rates we're thinking about financing, that means you've got 4% of GDP each year to pay the interest on the debt. Now, in an economy, if we get back to 2% inflation, it's going to be a while before we get there, and let's say underlying growth is 2%. That's roughly equivalent to being able to sustain 100% debt to GDP ratio. The problem in that, as you do that, is the interest payments to keep that stable have to squeeze out other spending, and that's the problem. The interest payments will get bigger, and if there's no counterbalancing reduction elsewhere, then those fiscal ratios continue to deteriorate. Now, if we end up in a 5% interest rate world, which I don't think we will for the long haul, but if we do, then the debt numbers start to become problematic. And then you'll have people saying, and this is one of the troubling things, they say, well, the U.S. will inflate its way out of the debt. Well, the Fed won't let the U.S. inflate its way out of debt. Yes, the Fed made some terrible mistakes back in 2021, continuing to ease by purchasing $120 billion of debt per month as inflation picked up. But you've got to remember, on top of that fiscal trend, the Fed is essentially selling. It's not actually selling, but by not reinvesting, it's forcing the Treasury to issue more debt to the marketplace. So the debt trends are sort of worse than the fiscal trends because of the Fed getting out of the quantitative easing game.
This is a political question, so forgive me. Any reason to believe that politicians in Washington somehow embrace austerity anytime soon?
I don't think so. There's just such a dysfunctionality in Washington, D.C., and with coming into the election process next year, and with divided government between the Senate and the administration on the one hand, and the House on the other, I don't see there being any kind of sensible reform package out there, and you do have the potential for these these battles that give you a problem the next time the debt ceiling comes around. Unfortunately, that's been kicked down the road for a little while, but you know, it's just as a mechanism, it's just really weird that you authorize the spending. And then you have a second thing saying, well, you've spent it, you've run out the credit card bill. Oh, but you're not authorized to pay the credit card bill. It was okay to spend it, but it's not okay to pay. I don't mean the US to pay off the debt, but that's the analogy.
Kind of odd. I agree with you. Every time this comes up, it's kind of odd. It's bizarre.
It's bizarre, and
you're not raising the debt limit for spending already agreed and already spent. In many cases, it's kind of odd. John, thank you. John Rydick of Green Capital. John, appreciate it. What a situation. Here we go again, somehow desensitized by the events of more than a decade ago. There's just a shrug of the shoulders this morning, Lisa. Is it justified? Divided opinion on that? Does it matter? I think the consensus is doesn't matter that much, at least not this morning.
Desensitized is the word of the day, I will say, to a lot of things, and that seems to be a trend.
Does it change anything for PGIM? Robert Tipp of PGIM Fixed Income up next from New York. This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. This Friday, Wall Street Week comes to you from Colorado. Join David Weston for the 2023 Aspen Economic Strategy Group meeting. Special guests Cecilia Rouse, Raphael Bostic, Brian Moynihan, David Cody, Austin Goolsby, and Larry Summers join David Weston for exclusive conversations on persistent inflation, rising debt, and demographic challenges in the U.S. and around the world. It's a Wall Street Week you won't want to miss. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
I disagree with Secretary Treasury Yellen's notion that this was arbitrary. It wasn't arbitrary. The U.S. is the strongest growth. It is able to service its debt. Investors around the world shouldn't be concerned at all. It'll be after we get over this initial market response, it'll be back to normal.
The Treasury market is in a class of its own. The words of Bloomberg Intelligence and Ira Jersey this morning. That, by the way, was Mickey Levy, the Berenberg Capital Markets chief economist. Has stirred plenty of debate and a collective shrug of the shoulders in the market in many cases, particularly in bonds without much movement whatsoever in Treasuries. This is what Fitch is essentially saying. They're making 3 points here. That this downgrade of the United States reflects, one, the expected fiscal deterioration over the next 3 years. The second point, a high and growing general government debt burden. And a third point, which I just find impossible to disagree with, the erosion of governance relative to AA and AAA rated peers over the last 2 decades. Pick out those 3 points. Point 3, Bramo, I find it really, really difficult to argue against point 3.
We were just talking about the potential for the U.S. government to default, not because of a wherewithal to pay, but simply because there is political gridlock in Washington, D.C. You say the third point is difficult to disagree with. Well, all of them are difficult to disagree with. And this is the interesting thing. People have been talking about the increasing debt load relative to GDP and the interest expenses that are surging. I mean, really climbing rapidly on the heels of rate increases by the Federal Reserve. So you put this together, there. They're not wrong, but people still shrug their shoulders and say, you know what? This has been the story forever. The U.S. has a stronger economy than ever. Nothing has changed. Why did you do this?
As we've said over the last 50 minutes or so, is it justified and does it matter? Two very different questions we have to grapple with this morning. Let's deal with the latter with Robert Tipp, the Chief Investment Strategist over at PGIM Fixed Income. Robert, does that decision by Fitch, more than a decade after S&P Global Ratings did the same thing, change anything for you and the team this morning?
No, not really. I mean, the United States is unrivaled in terms of having a market for government bonds that is liquid and secure, and that's going to remain the case for our generation. But it is interesting, and it does cause people to stop and pause and ask these questions, which they should ask. And in terms of the last 20 years, I would say there has been an erosion in terms of the U.S. and our governance relative to other countries. Take a look at the European Union, for example. They have a stability and growth pact, which they flout, but it's on the sidelines and it is debated. So, you know, there is an acknowledgement that debt matters, that you want to be sustainable. And the United States has had a soaring debt. You know, it's not just a little bit, it's not a creep. It's from 40% debt to GDP to rocketing, you know, towards and over 100% in the last 20 years. And this was never the case. You know, in the last century, people would rack up debt and they would pay it down. And then people would wring their hands about the countries that ran 100% debt to GDP. I don't know if you recall, the time in the Eurozone crisis, all of those analyses that 80 to 100% was the death zone for sovereign credits. Now nobody cares. Monetary finance is commonplace. And so having something like this, even though these are really vanity ratings from a practical perspective, it causes you to ask the questions, because over 50 years, 100 years, eventually you do lose flexibility. But in terms of, are we doing a trade on this? No.
It is the independent assessment of America's creditworthiness on behalf of Fitch, and to some people it matters, to others it doesn't. Many people on this program, it doesn't seem to matter. Robert, I wonder if this matters to you. The Treasury Department coming out and essentially telling us that net borrowing, the estimate for July through September this quarter, is going to be $1 trillion. It's not going to be the 733 that they thought it would be back in May. Does that additional supply change where you think this yield curve is going to develop into?
Yeah, now we're talking, John. Yeah, the deficit had some low prints looking back several months, which were kind of surprising, given that actually, you know, nobody is trying to reduce the deficit anywhere, but especially here in the United States. So having a few hundred extra billion hit the market, I think, does matter. And what we're talking about is a little bit of an impact on the absolute level of rates. It puts a little bit of pressure there, but also puts pressure on relative rates. That's really the thing to watch. You know, if you go back 30 years, treasuries used to trade rich to swap rates, as if there was a scarcity or a quality premium people would pay up for treasuries. Now, by the time you get to the back end of the curve, treasuries trade cheap, basically to the Fed funds swap curve, to the SOFR curve, to you know, a riskless alternative out there that doesn't have the supply pressures of the U.S. Treasury. So this definitely makes a difference in terms of relative spreads. And as these numbers continue to become more and more unbelievable, I mean, on a daily basis, the United States Treasury, on a day when they're hitting the bill market, the coupon market, will do more than all other countries in the world combined. And that's a pretty stunning number.
Robert, you were talking about how for a number of years we cared about 80 to 100% debt to GDP. Now no one cares. We have the U.S. with about 120% debt to GDP. Does that shift where people start to care again, given that rates are not zero anymore? In other words, are we in a new regime where interest rate pressures and expenses suddenly make this a top priority and make debt matter again from a fundamental perspective?
Yeah, well, we're not there right now. I mean, the UK used to be a place that had, you know, a clear mindset on this. Now the places that have a mindset that are active or where you see it in the press are smaller countries, and it's incredibly limited. If you go back to the 90s, it was incredibly different. I differ with John Riding's take that the Fed will stop them. No central bank is stopping governments from issuing debt these days. If you go back to the 90s, even coming into this century, Greenspan had the nerve to speak out, say, this is my job, that's their job, but I'll tell you, in the abstract, there should be a long-term fiscal construct for controlling the amount of debt. And now that's gone. So, and there were, technical things people may not be aware of. I mean, there was an effort to consciously balance the budget, which succeeded. And by coming into this century, we were in surplus and we were on track to literally pay down the debt people were talking about. But things like pay-go, various restrictions that actually kind of contained these deficits over time, those have all been scrapped. And, we need to get to that time where people look for sustainability so that when you hit a crisis, you have the fiscal flexibility to react.
Given the fact that there doesn't seem to be a lot of impetus in Washington to bring that under control or pay it back or have that ammunition, as you were saying, how high could long-term yields go?
Right. So, like I said, I think the fundamentals are driving the level of yields, and those are around current levels. I think if the expansion continues and it turns out that this drop in inflation we've seen here is transitory, you could get a little bit of an increase in rates, 10s over 4%, but it's going to be more owing to the fundamentals than to this technicality here. I think, though, that, Fitch and on the governance side, on the one hand, it's interesting timing because in this last showdown, there was, open talk of those 13 words you could take from the 14th Amendment about the sanctity of the U.S. debt. And that was uplifting. But the fact of the matter is the politics, ping pong, and you have lawmakers that are upset about an unfettered rise in the level of debt. And they can, really cause a lot of trouble in that process. So I think it's noteworthy that Fitch brings this up, and it's worth keeping in front of people.
Robert Tipp of PGIM Fixed Income. Robert, thanks for jumping on in front of the camera to give us your latest thoughts from PGIM and what it means for this fixed income market. Nothing yet so far this morning, I think, is the general consensus. What is the alternative is a question that we're going to talk about repeatedly through this morning. The team here at Bloomberg getting a variety of sources on the phone, in front of a camera, emailing in, working out what on earth is going on. This is Pendle Group, okay? Allow me to share this quote with you. What would be the alternative? Euro govies, that's still a currency breakup accident waiting to happen because of a lack of fiscal unity. China, nobody wants to own that sovereign risk. Japan, the BOJ still owns half the market. It's a privileged position the US is in, that if you ask people this morning, what's the alternative? They can't find one.
So basically, the United States is saved by the incompetence of other governments, or basically the lack of conviction around the other nations, and the idea that even if they're bad, they're not as bad. And so it's a relative game. The bottom line is that treasuries are so entrenched in the global financial system. The dollar is so entrenched in the global financial system that countries that try to move away struggle. And that has been a perennial issue, especially when, people are talking about the weaponization of the dollar, certainly during Russia and some of the other things. This is going to be an ongoing question. When does it matter is going to be a key one also.
It is the sun in our market universe and has been for a long, long time. Henrietta Trays of Vader Partners on the political fallout down in Washington, D.C. coming up shortly. We'll touch base with Anne-Marie. Looking forward to that conversation down in Washington. We'll speak to Brian Weinstein of Morgan Stanley Investment Management on the bond market. He's coming into the studio here in New York. And we'll speak to RBC's Amy Wu Silverman. All of that in the next hour on Bloomberg.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
On the next episode of The Circuit.
I was like, this is a way to change culture. Like, what a different world. Of course, we know for girls, it means so much to have female athletes to look up to, but for boys, to look up to women also, it's really for everyone.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rate World Cup.
This is a 3 as the economic picture does.
The BOK is getting ready to make.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I sympathize with the analysts at Fitch and take my hats off to them for doing this when it's not a moment of brinksmanship.
Clearly, it's not good news, but if we look at the initial market reaction, pretty moderate reaction in the bond market.
No country that has the strength of the U.S. is going to be affected.
The main question is, does this compromise the reserve currency status of the U.S. dollar?
I've learned very painfully that one never wants to forecast the demise of the dollar.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I cannot tell you how many messages I've had this morning, emails that start with something like, nobody cares about Fitch. Live from New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Farrow, reacting to the news yesterday afternoon after the close that Fitch, more than a decade later, joined S&P Global Ratings, stripping the United States of its AAA rating and making 3 points. The downgrade of the U.S. reflects the expected fiscal deterioration, a high and growing general government debt burden, and this line, Lisa, which we've talked about all morning on Bloomberg TV and radio, the erosion of governance in Washington, D.C.
Fitch originally came out flagging that they may downgrade the U.S. in May during the height of the brinksmanship that we saw down in Washington, D.C. He's now coming out, Fitch is now coming out and saying, you know what, we're going to go ahead with it, even though you guys did resolve it. And this comes at a time when there are some real issues that are affecting markets, which include how big the debt is getting and how high the interest expenses are going. So you did see that reaction in markets yesterday. So it is important to flag this, even if no one cares about Fitch.